Hey everybody, it's Naval and Nivi. We're going to be talking about something very different than what we've talked about in the past. In the past, we did Venture Hacks, which was all about the game theory of venture capital, and it helped entrepreneurs raise money. We talked about how to get rich, which was general advice on wealth creation for the average person who's starting a business. Now we're going to talk about angel investing. This one is focused on a much more narrow audience. We expect this podcast to resonate the most with people who are in a technology hub and have started investing but are not yet pros at investing. So brand new angels, VCs, and founders who are dabbling in it. Let's say you're living in Silicon Valley, or you're in Shanghai or Beijing, or you're in Bangalore, or you're in London, or you're in New York, and you get access to a lot of interesting tech companies. You're in the tech business, you have some extra money that you've made along the way, or you've raised some money. How do you learn to be a good investor? This assumes that you have some familiarity with investing. It's not going to be a cold start. There are some resources we can point you to for the cold start. Paul Graham wrote a piece called How to Be an Angel Investor. There's How to Be an Angel Investor Part 2 on Venture Hacks. There's a course called Future Investor. You can look at all of those for the basics. We're going to focus on some more advanced topics in this conversation. We're going to talk about things like how to figure out what a fair valuation is, what are the pitfalls of bridge rounds, how pro ratas work, how can you squeeze into a round when there are VCs leading, when a co-investor is providing a valuable signal versus when they're just talking their own book, how to size up markets and startups quickly. Should you specialize in a single vertical or should you diversify it into multiple verticals? This podcast is open sourcing some of the knowledge that we teach at Spearhead. Spearhead is a fund that we built that trains the next generation of angel investors. It takes founders, gives them small checkbooks, and then teaches them the skill of investing and mentorship for building something that'll be valuable to them for their entire lives. We're living through a very unique time when, as Andreessen says, software is eating the world. We're undergoing a phase shift where technology, rather than just being adopted by knowledge workers, is being adopted by everybody. This transition that we're going through means that it's a gold rush era in technology. If you happen to be living in one of the technology hub cities, there's only a handful of those. And if you have to ask if you're in one of them, then you probably aren't. Usually it's obvious when you're living in one of them. There'll be hundreds of startups at least within that city. There'll have been some exits. There'll have been some people who got rich off of it. If you're living in a tech hub and you're in the tech industry, you're already halfway there. That's half the battle. You are well positioned to angel invest. And if you're in the tech industry and you're not living in a tech hub, then you should consider moving to a tech hub unless there are strong lifestyle reasons that keep you away, such as family or quality of life, which often is higher outside of the technology hubs. So getting into the tech hubs to do the angel investing is half the battle. You can do it remotely, but the odds are stacked against you. You don't have the trust networks. You don't see enough of the deal flow. So then it's better to work through a proxy, like investing in a trusted friend's venture fund or going through AngelList or coming in for YC Demo Day and so on.
You think this is just for people in Silicon Valley, or does this apply in New York? Does it apply in Seattle, Austin, China, Bengaluru?
I think it applies in probably about a dozen, 2 dozen cities around the world. The thing that's hard here is that some of these cities are emerging and some are not. Seattle is probably pretty stable. Austin's pretty stable. You can probably find good deals there, but you really have to see everything and you have to have access to everything and realize that maybe there's one or two great ones that'll be created there every year. Silicon Valley is a little more forgiving in that there's maybe 20 or 30 great companies being created every year, and you just need to get access to one of those from a larger pool, of course. Someplace like Bengaluru or maybe even Kuala Lumpur, these might be up and coming cities, but then timing is hard. Is this when the city breaks through? Is this when the tech industry there breaks through? You're in Australia, if you invested in Canva, great. Or if you invest in Atlassian, great. But if not one of those two, then there's not as much of a pool. So timing becomes a lot harder, but at the same time, your returns can potentially be a lot higher because there's less competition, the valuations are lower, the risks are higher. What you don't want to be doing is sitting in a city that doesn't have a history of producing good startups, where you only see one or two startups a year. You invest in half of them and you're paying Silicon Valley prices because they're looking at Y Combinator Demo Day and keying off of the valuations there. It's certainly much safer and easier to get started in San Francisco or New York or Beijing or Shanghai or Bengaluru. If you're a pro, you can play in London, Austin, Seattle, Denver, Boulder, Chicago, etc. Anything below that, and you better know what you're doing. We definitely have seen this phenomenon on AngelList where angel investors have been investing locally in a city that is not producing good tech startups, will basically surrender and then start investing through AngelList into Bay Area startups. And they just see the quality and the returns are so much higher.
What's the best indicator that a startup hub is working? Is it exits? Is it a thriving community of other angel investors?
Unfortunately, it's exits. The normal angel investing dynamic starts with founders start a company, company does well, founders and early employees get rich in the IPO or the acquisition, and then they start investing money in their friends and engineers and designers and marketers who work with them at their company. And they feel a lot more comfortable doing this early investing because that's how they made their money. They made their money through tech startups, so they want to put it back into tech startups. There's a lot of false starts where you'll have a lot of angel investors pop up in an area and they'll invest in a bunch of companies, but then those companies get stranded because there's no Series A or Series B VCs there to invest in them. Or because there's only one or two Series A or Series B VCs, when they come in, they pay low valuations, they wipe out the early investors. They convert them to common, they cram them down, they put warrants on top. So funding markets to some extent develop in reverse. The least risky investments are mezzanine rounds right before the company goes public. The next least risky investments are Series Ds and Series Cs, then more riskier Series Bs, even more riskier Series A, and the most riskier angel investing. So, in a weird way, angel investing is the thing that should develop last. That's not always the case because if a company can break out with just angel money, then later stage money will find it almost no matter where it is. Or that company can move to a later stage hub. But now you have a big gap between your investment and then when the next investor is going to show up. And that means the company has to get really, really far and very little money. Now, this is the internet and this is America, so we got to give you some disclaimers. Angel investing is a great way to lose your money. There's an old quip: how do you become a millionaire? Start as a billionaire and start investing. This is a good way to lose money if you don't know what you're doing, or if your timing is bad, or you're just plain unlucky. This is not investment advice, but if you're already in the profession or in the hobby of angel investing, you may find this useful. There are tons of important exceptions to everything we're going to talk about.
Like everybody else, our advice is going to be well meaning, but we'll probably end up talking our own book in the process. A lot of what we say will be speculative, but it'll be stated as if it's a fact. A lot of other things we say will be just plain wrong.
Technology itself is changing very rapidly, as does the investment ecosystem. A decade ago, Y Combinator was brand new. AngelList didn't even exist. The first round capital platform wasn't there. Andreessen Horowitz wasn't there. You didn't have a lot of late stage investments by hedge funds. You still had companies going public earlier. So the market was very, very different.
This is really one unique approach to angel investing. The things we're going to talk about might work for us from time to time, but other people might take the exact opposite approach or completely different strategies and have similar or better results.
We're very focused on early stage technology startups in San Francisco and Silicon Valley. A lot of this may not translate to other locales, and it almost definitely will not.
We'll also be discussing startups and funds that we've personally invested in and have a financial interest in.
And we're constantly changing our minds and learning. That's what intelligent people do. We hold contradictory and opposing thoughts in our head at the same time. We have a multitude of opinions that often contradict each other. This is not math or science or equations. And we're always changing our opinions. As Mark Andreessen says, strong opinions, loosely held. The best way to make money in the technology industry, like any other industry, is to be an owner of a piece of a business. You're not going to get rich renting out your time. You must own equity, a piece of a business, to gain your financial freedom. So, how do you gain substantial equity in a business? The classic models are you start a company and you become successful. This works as a founder. You own a big piece. It's high stress, very grueling. Very few companies succeed. You may have to get back up at the plate and take a few rounds at bat. It may take you a while. A second way is you can be an extremely competent execution person who gets recognized so that when the next successful company is scaling, whether it's an Uber or Dropbox, then Travis or Drew call up their favorite investors and say, hey, who are your 10 best engineers that you work with that I can recruit right now? Who are the 10 best designers you've worked with that I can recruit right now? And someone who's done a great job at other companies for investors and entrepreneurs before will get paid a fairly large amount of equity for joining a company that's already solved product market fit and is a rocket ship. Then finally, you can do it as an investor. And as the hits become bigger and bigger and the returns become more and more nonlinear, it makes more and more sense to play as an investor and a little bit less sense to play as a founder. The reason for this is because the upside is nonlinear. When you invest in a startup, you could, in theory, make 100x, 1000x, a 5000x, a 10,000x return if you were in a Facebook seed round, for example. And your own company, you may own a lot more of it, but you may only make a 10x or 100x return. The human brain is not wired to understand nonlinearities. But the people who do, people like Paul Graham and Peter Thiel, end up becoming billionaires as investors rather than through companies that they had themselves directly started. Now, being a founder is a lot more fulfilling. Many of the investors, they wish that they were building something because it does give you a deeper sense of purpose. There is that sense of teamwork and really being involved. On the other hand, it burns you out and it ages you quickly. Being a founder your entire life is a very tough road to go, and most people do not have the constitution for it. Angel investing is something you can be doing when you're 50, when you're 60, when you're 70 years old. It's something you can do part-time. It's something you can do if you're partially retired or if you're in maternity leave or paternity leave. It's something that you can get better at even if you're not devoting yourself completely to that field. And it's something that can make you money when you're too tired or have too big of a family or have some kind of a health issue. So you can't just be cranking as an entrepreneur. Warren Buffett is one of the richest self-made people on the planet because he's been compounding for a long, long time. He started reading annual reports when he was 10, 11, 12 years old, and he's been going strong. If he'd started after college instead of starting when he was 10 years old, he would be nowhere near the top 400 lists on Forbes because the magic of compounding wouldn't have worked. There's a famous line, know something about everything and know everything about something. So in that sense, it's great to have been a founder and then also to do some investing. The three things that it takes to get into the investing business are deal flow, judgment, and capital. Capital is the hard one. Either you made some money before or other people trust you enough to give you capital. Many of the top VCs are related to, married to, or come from families that have an enormous amount of capital. Sometimes you look at those people and you scratch your head and you say, how is this person in the venture business? Well, they had a lot of family money or they married into money. Or they were managing money for somebody else, or they were friends with a billionaire or had access to some large fund. And that access to the capital is what got them in the business. If you join Spearhead, we actually give the Spearhead leads, who are founders who we're training up to be investors. We give them $1 million checkbooks, and then we help them raise more money from limited partners later on. So that is another way to get capital. You can always raise it from friends and family, but this is both the hardest and the easiest depending on who you are. The second is judgment. As they say, good judgment comes from experience, and experience comes from bad judgment. Often it just takes time to build up. Judgment can often be about applying your highest standards and your taste in the things you know the best to other people. Very often, as a founder, you have a very high bar for yourself. You only want to recruit the absolute best. You only want to do your best work. You're constantly into self-improvement. You're always the worst critic of your own business and your own product. Every little thing in your product that's wrong bothers you. But then you meet somebody else and they're raising money and you fall in love with their idea and you ignore the fact the person doesn't seem that smart, or it's not someone that you'd actually work for or even hire, or their product is only half baked or half finished, or they're executing slowly. You just look past all that. You lower your judgment because you start fantasizing about all the things that could go right. So it's very important when you're investing in other people that you keep a high bar. You have to have taste. Some of the best investors that I know are incredibly difficult people. It's very hard to please them, and they see the problems in everything. In that sense, a good investor can often be a lot more cynical or pessimistic than a good founder. A good founder has to be a rational optimist, whereas a good investor sometimes will bounce maniacally between being optimistic enough to see the future and get into the deal and being pessimistic enough to see all the downsides and pass on 9 out of the 10 that they look at. If you're doing more than 1 out of every 10 deals that you look at, you're probably being too optimistic. If you keep stumbling into all the great deals all the time, that says more about you than it does about your deal flow. There are always exceptions, of course. If you're sitting in the latest YC batch and you're getting to see everything good that's going on early, or if you're running the Stanford Entrepreneurship Club and you've seen tons of deals go by, and you may have a unique advantage to your network. The last piece, though, the deal flow and the access, that's what we're going to focus on, which is how do you get deal flow? How do you get good access? Deal flow and access are not the same thing. You can get deal flow by going on AngelList. You can get deal flow by going and sitting at Y Combinator Demo Day. You can get deal flow by going to any technology conference bake-off. You can get deal flow by watching Shark Tank. But that doesn't mean you have access into those deals. It doesn't mean that you have the ability to invest in those deals when you want, on the terms that you want. When the deals get really hot and you get cut out, that is assigned to you that you're going to perform poorly as an angel investor. You need to do whatever it takes to up your access. The technology industry is becoming the place where wealth gets originated and then it can get spread out. But increasingly, the Wall Street financiers are coming to Silicon Valley to invest in companies before they get to Wall Street. By the time a company goes public, you can pretty much bet that anybody who had any connections, who had any appetite, who had any capability, got a bite at it. So if you're buying a tech company when it goes public, you are literally last in line. It's not to say you can't make money, but the odds are way down because this fruit has been picked over many, many, many times.
The last bunch of financiers who were sitting in the right place at the right time, we call them Wall Street. These were the people where you used to get capital for your startup. There was no other market for fundraising until you had the metrics to go public. Now, Silicon Valley's turning into the new Wall Street, except it's not as formalized and organized and segmented as the traditional Wall Street. The JP Morgans haven't popped up and the NASDAQs haven't popped up yet.
This is going to fly in the face of conventional wisdom. For the average person, you should be saving for your retirement. But I never set out to save anything. I reinvested everything. In economics, there's the identity S equals I, savings equals investment. So even if you save into your 401k, it's actually just getting reinvested, but it's getting reinvested into some very quote unquote safe but very unproductive parts of society, such as the government. You're investing in the DMV and the Defense Department, and their returns to date have not been spectacular. It's essentially just whatever money they can take at gunpoint from both taxpayers and foreigners. Generally, it's probably a better bet if you're in the tech industry to invest back in the tech industry, especially if you're young and especially if you can get diversified. Invest in the smartest and best and brightest people that you know around you, as opposed to faraway people in faraway lands with faraway motives who are frankly just not as motivated and have trillions of dollars of capital flowing into them. $50,000 in your IRA isn't going to make much of a difference to the US government when it gets put into a T-bill, but 50 grand invested into an entrepreneur down the street is going to make a huge difference to their lives. And if you can find 10, 20, 30, 50 investments like that, at least one or two of them will pay off, assuming that you listen to us and build up some skills along the way. Most of my net worth is illiquid and lying in startup companies. But I sleep well at night knowing that I literally have hundreds of teams of brilliant entrepreneurs who study at the top schools and are leveraged through code because they have engineering degrees, great designers. They're leveraged through capital because they've raised venture money after I invested. They're leveraged through products that they're building that have no marginal cost of reproduction and using the most modern methods of distribution. All of them are working very hard to build things that could be massive and change the world. And it's just going to take a few of them work out for the entire portfolio to balance out. If you have a 1000x return in your portfolio somewhere, which is not that unheard of in angel investing, you could have made 100 investments to get there and your overall portfolio will still be a 10x even if the other 99 go to zero. The returns in angel investing are kind of interesting. There's this meme that goes around that angel investors lose all their money and that VC is a terrible business. This is somewhat true and somewhat not. It's true if you start aggregating VCs and angel investors from all across the world. But if you stay focused on technology hubs, it's largely not true. A competent angel investor in Silicon Valley who's plugged into the network and knows what they're doing and has a broad portfolio can expect to make somewhere between 3 to 10 times their money over a decade. That's quite a return, although there is a very high specific knowledge and labor that goes into each investment, which is not being counted. Also, keep in mind that these are capital gains, which are usually taxed at lower rates than income, partially because it's a secondary tax on corporate income. It's already been taxed once at the corporate level. And also, there are tax breaks for angel investors, ranging from the qualified small business stock exemption in the US to some very favorable tax investing breaks in the UK and other countries. From a tax advantage basis, if you're willing to tolerate the high risk and the illiquidity, it's very hard to look at any other asset class where you can make as much of a raw return on your money as you can as a patient, diversified, plugged in angel investor. One way to think about it is the less efficient the market and the more wealth the underlying asset is creating, the better off you're going to do. For example, art doesn't really create that much wealth. It's more of a tax haven / speculation instrument. And same with wine. The asset itself is not that wealth generating, but the underlying market is very inefficient, so you can make money more easily. Gambling is wealth destructive. It actually destroys wealth. So it's not a great asset class to play in unless you're the casino owner, in which case you have an edge on everybody else. Angel investing is odd in that very few people can play in it. Very people have the know-how, the geographic access, the capital, and the risk horizon and the patience. But at the same time, the underlying assets that you're investing in are changing the world on a daily basis. I see a lot of people on Twitter who could be good angel investors who are sitting in Silicon Valley, who have access to deal flow, who are in the tech industry. And I see them spending a lot of time thinking about macroeconomics. What if the Fed's going to cut interest rates? What's going to happen to the trade war in China? Or they're out shorting stocks, or they're investing in special economic zones, or they're buying and selling real estate and flipping that, or I have a very good friend of mine who's a great VC who's also running a rental business on the side. And I always scratch my head a little bit. You're living inside the gold mine. There are people literally digging up gold next to you. The returns in this industry are higher than anything else. You understand it so well, you have specific knowledge. But there is this contempt that you have for investing further into the industry that just comes from your own familiarity. And if you're in the tech industry, you should be doubling down. I don't know of a better industry on the planet or a better place on the planet to be investing for today.
Why is it so important to get allocations in the deals that you want to get into? What happens if you don't? Isn't there just a lot of deal flow out there?
Almost every angel investor, if you look at their portfolio, the majority of the returns come from one deal. And then if you look at the remaining returns, once you take that top deal out, the majority of those returns come from the second deal. So it's extremely nonlinear. If you were to take the top 2 to 3 deals out of every fund's portfolio, you'd basically have a negative performing fund, as opposed to what would normally be a 4, 5, 6, 10x fund. One company out of 100 or one company out of 1,000 accounts for all the returns every year. So it's all about adverse selection. When you get cut out of the deals that you wanted to get into, the odds of that being one of those big winners goes from, let's say, 1 in 100 to 1 in 3 or 1 in 5. What'll often happen is you'll meet a company, you're taking your time deciding, and then all of a sudden a top branded investor rolls in, writes a big check. Next thing you know, everybody piles in. There's a strong signal. And now the entrepreneur says, sorry, the round's closed or only have 10K left for you. These are the times when brand makes a difference. I partially started AngelList because I was cut out of some very big deals early on that to this day I have some qualms over. These are career defining deals if I had been in that would have made tons of money. But my brand simply wasn't strong enough. Even though you want to be non-consensus right, there does come a point at which consensus has value. When the Sequoias of the world show up, when the statistics become more baked, when the founders are better known, when there's more information on the table. And to some extent, Sequoia investing is a partially self-fulfilling prophecy because it takes away some future financing risk and it gives the company the ability to stand out when it's recruiting or going for PR. This is why it's often better to back another great angel investor and pay them their carry than it is to go and try and be one of your own. A lot of people balk at this idea that, oh, I'm going to pay you a management fee or a percentage of the upside. Frankly, in angel investing, it's a steal. The old 2 and 20 model was put in place by KKR, which was a big private equity firm managing billions of dollars. The fact that you can get someone who's managing $1 million to charge you the same 2 and 20 when their labor as a proportion of the invested capital is far, far higher, it's dirt cheap. Go to YC and tell them you would like them to invest your money at the same time they put in their own money at the beginning for 2 and 20, and they'll laugh you out of the room.
To get into good deals, you need to build a brand, typically by adding value to the startup in some unique way. Why don't we talk about 101 different ways to build a brand?
This is the meat of it. This is the heart of it. We'll get into how to develop good judgment. We can get into the ins and outs of raising capital. All of those are secondary. The single most important thing is having the ability to get into a deal that you want to get into, and that is access. And the way to get access is to have a brand. A brand in this context is an authentic reputation that you have with the founders and other investors that tells other people around the table, yes, let's let this person invest in our round, even though it's scarce and everybody wants to get in now that the signals are there. So how do you build a brand? The classic brands in the venture business have a reputation for having made great investments. Sequoia was built this way. Andreessen was partially built this way, where you pay up for deals in later rounds on companies that already have product market fit. You associate with their brand, and then you use that to get into earlier and earlier, hotter and hotter deals. So the best way to build a brand is almost a tautology, which is to invest in the winning companies. And then that gets you into the winning companies. Okay, but that's circular. It doesn't help that much. Another way to build a brand is to provide something that's pro founder that the environment does not yet already offer. This could be a stance. For example, Andreessen Horowitz is a famously founder friendly stance. They want to see their founders run the company. It could be content. I've built a brand through Twitter. Elad Gil built a brand partially through the high growth handbook that he wrote. Reid Hoffman has written some books, of course, although he's got many other reasons to have a good brand. Paul Graham wrote amazing pieces that attracted everybody to YC and Hacker News when he was getting started. Fred Wilson still maintains the most popular blog in venture capital at AVC. Brad Feld laid out a lot of the mechanics of VC investing that allowed him to run a fund out of Boulder, which is unusual. So you can definitely build a brand through blogging. David Hornick and Andrew Anker and I started Venture Blog, one of the first venture-related blogs back in the day. Should have stuck with it. A lot of the great brands in recent memory have been built by being extremely founder-friendly and by providing either content or networks or software or platforms or access for entrepreneurs that did not exist before. Whatever your brand is, it has to be clearly articulated, it has to be messaged, it has to be authentic to who you are, it should be differentiated from what everybody else is offering, and it should resonate with entrepreneurs. The worst strategy you can take is to take a lot of coffee meetings or say, oh, yeah, I'm a good passive, hands off person. I won't bother you. And I'm always available to help. It's too generic. You can build a brand through your advisors and limited partners. But if you have a small fund and many of the investors and advisors to your fund are, let's say, professors of computer science at major universities, then entrepreneurs will want you as an investor because you have access to these people who can bring in grad students or help technology diligence or solve hard algorithmic problems. You may come from the real estate industry. So all the real estate tech plays want you in because you have a deep understanding of real estate and your real estate investors and your real estate contacts and your real estate properties.
You could be the world's expert on helping the startup raise its next round. You can build software for startups like AngelList. I think there's still 5, 10, 100 different things in the world of software to help startups that haven't been done. You can be an expert on raising money from international investors, raising from China or Brazil. You can break into a new market by backing the scientists and the technologists in a new market. You can be a world's expert at scaling. You could build open source tools for startups.
There's extremely little innovation in the venture capital business. It's actually quite easy to stand out. You just have to be willing to do something that other people haven't done before. In other words, you have to be willing to take on accountability and the risk of being wrong.
Do you think someone will try to build a brand around buying common stock from entrepreneurs at some point instead of purchasing preferred stock?
Some people have already done that a little bit. Andreessen Horowitz started to do that in the sense that they became registered investment advisors so they can do secondaries. You could argue that's actually a core part of YC's brand. They buy at a very low valuation in that first round, but they're buying common, so they're completely in the same boat as you. There's no branded firm or angel investor who's writing large checks that is buying common. I think it's a very clever strategy and something that we may yet see happening. And it does have the problem where the company can shut down and keep your money. But there are clever ways around that. You could say, okay, I'm buying preferred stock, but after 2 years, it converts to common stock. So you're running your company for a while. When you've burned through my cash and you raise somebody else's cash, at that point, I'm no longer sitting on top of you in a liquidation preference overhang. But at the same time, my money has already been spent. So it's not like you can shut down the company and run off with my money. Number one was being a good investor to begin with. Number two is by creating content that helps entrepreneurs. A third one is you can build infrastructure, a platform that helps entrepreneurs. Paul Graham can get deals because of Y Combinator. Nivi and I often can get into deals because we started AngelList, and that helps entrepreneurs at scale. Ryan Hoover can get into deals because he started Product Hunt. The first round capital guys have the platform, which helps them win deals against other VCs. Andreessen Horowitz has its famous platform of people who are helping out companies left and right. That's another example of a way to build a brand by helping founders. You could also start a conference. Jason Lemkin did this with the SaaStr conference. Tim O'Reilly and O'Reilly Media Ventures have both publishing and conferences. Stephen Lurie is great at recruiting. So he started Team Builder Ventures. He put it right in his brand name. So now when he goes to companies, they know what he's good for. They know why to give him a piece of the round and what he's going to help them with. There are nuances to this, though. A lot of times, a VC will say, we need to build a brand, therefore we need to have a blog. Let's hire a content writer and write a blog. Or, man, I better up my Twitter game. Let me get over on Twitter and start telling entrepreneurs what my investment criteria are. The truth is, you're not going to build a brand because you want to build a brand. The brand is going to be an authentic expression of who you are. So, whatever your unique insight already is into the technology ecosystem, the venture business, investing, and startups, you have to express that in the most authentic way possible. So, if you're good at Twitter, get on Twitter. If you're good at blogging, get on blogging. If you're good at writing books, get on writing books. If you're good at speaking, go to conferences and speak. If you're good at talking, do a podcast. But you're not going to be successful by aping somebody else. It's going to have to be authentic to you. Also, the media airwaves are now crowded. So you have to create top quality content. You need to have top quality distribution. The work that Nivi and I do in this podcast, even though it's an amateur effort, we cut things up into snippets, we clean up the voices, we create transcripts, we create highlights. We're staying at the leading edge of the curve. Sure, other people will copy us and catch up, but by then we'll be somewhere else. We may be off to writing a book, or we may be doing a roadshow, or running an incubator, or building another software platform. But because we're always tinkering at the edge, and we enjoy that tinkering at the edge, it's easy for us to stay ahead of the competition. My original brand started out, strangely enough, growth hacking, where I co built a Facebook app that got 20 million installs pretty quickly. I used that as my calling card when I was going and talking to entrepreneurs. This was back in the early growth hacking days, before growth hacking had a bad name. A friend told me about Twitter, and I tried it and I liked the product. At the time, it was all text message based. This is a pre app. I tracked down Evan Williams, and Ev had just given back investors a bunch of money for a failed podcasting venture called Audio. He'd kept Twitter, which was the one thing out of that studio that looked interesting, but was still very much a toy. I went to Ev about investing. At that point, his round was done. He had a little bit of allocation left, and he basically was posing the question of, well, why should I let you invest? I got up on the whiteboard and I laid out what little I knew at the time about growth hacking. This was before Andrew Chen blew it open for the world. I did that for about half an hour while he and his deputy watched. And at the end, he said, "This sounds great. We're not going to do any of it because it's against our ethos." And I respected him for that. But he was impressed enough that I cared and I thought about it, that I got a chance to put into Twitter. And that was my first major angel investment that worked out.
Are there any new angel investors that you think have done a good job of building a brand recently?
I don't know if they necessarily build a brand to invest, but I think they'll have a brand through their natural activities, and then that will give them the ability to invest. The rest of it, the judgment, the capital, and so on, is still up to them. I think Ryan Hoover has a great brand. His Twitter game is among the best I've seen in the world. He's always community building on Twitter just by the side effect of breathing. He's going to have a good brand as an angel investor, especially into consumerish things. Another good brand is Patrick Friedman. He's basically investing in startup countries and sovereign individual projects. It's a unique enough thesis and a unique enough angle that all the libertarian types and all the free state types are going to flock to him. Just by being the first one to put down a stake in the ground and saying, I'm going to fund these kinds of activities, means he'll get to see all of the limited deal flow in that space. And at the same time, there are lots of other projects, especially in crypto, that aren't necessarily about starting a free state, but they overlap. And the people who start those companies have sympathies towards free state projects and are themselves sovereign individuals. These are people who signed the petitions to free Ross Ulbricht and Julian Assange and so on. And I'm one of them, by the way. So they're going to be naturally inclined towards
There's
letting him
probably
invest.
some ways to build a brand that are going to get you stuck in ways that you don't want to be. For example, you don't want to build a brand around just a specific market thesis, right?
You don't want to have a brand around the transition from X technology to Y technology, because when that transition is complete, so is your brand. You also don't want to have too narrow of a brand, or a brand in a space that doesn't materialize. If you have a clean tech brand that's focused entirely on solar, and solar doesn't arrive on schedule, then your entire area of expertise is shot. When you're first starting out, because of your expertise and your network, and because you want to raise capital, there's a pressure to specialize. But if you look at the top VC firms, they're actually rarely specialists. They're usually generalists. And even when they specialize, they'll specialize in being weird, like Founders Fund. They specialize in a lot of deep tech deals and weird deals, but they don't specialize further than that. They don't say we're syn bio only, or we are AI and machine learning only. You have to resist that urge, because very often these trends don't materialize. I'm old enough to remember when clean tech was a wave that cost Kleiner Perkins a lot of money, or when Java was a wave that cost investors a lot of money, because those never turned out to be massive markets or took a lot longer than people expected. You could argue in clean tech, if you got into Tesla or SpaceX, that forgave everything, but it also means if you didn't get into Tesla or SpaceX, if you weren't in the Elon Musk mafia and you were in clean tech, you missed everything. So you don't want to be too narrow. At the same time, if you're too broad, then it's hard to stand out. Then you're back to, I'm a good person who does coffee well, let me invest. It's better to build a brand around your unique capabilities and your unique platforms and assets, but not around verticals.
Do you still think there's an opportunity to build a brand at the pre-seed stage before the accelerators or simultaneous with accelerators?
Accelerators exist to give advice on how to start a company at scale. The accelerator round isn't really there because they're giving you the capital. They're not giving you that much, but they're giving you important know-how, how to put your company together, how to recruit, how to rev your idea, when is it ready for investors, how to get your MVP out there, how to measure customer growth, how to approach the first customers and all of that. The training wheels until you're ready to go raise money. And the truth is, an angel investor can do this. They just have to put in the time. And I actually think this is the best place to play because the valuations at the so-called seed ranges are where A round used to be. If you want good valuations and the best deal flow, the best way is to create it yourself by allying with entrepreneurs early on, becoming their shadow business co-founder. Technical entrepreneurs today, builders, when they start out, they often have to give up half or two-thirds of their company to a seller to put the company together for them and raise the money. You can be that shadow partner. You could help them put the company together. You could put in the first little bit of money. You might even be able to get common equity in addition to your investment or favorable investment terms. And then you can help them recruit the seller later on for 5 or 10% of the company as opposed to 50% of the company.
If you're investing at the pre-seed stage, you can back great teams, you can set the terms that you want, and you can get pro rata rights.
Pro rata rights are the ability to invest in later rounds. Let's say that you own 5% of a company through your original investment. That means every round they raise in the future, your pro rata right would give you the right to invest another 5% of that round. Even though you already owned a lot to begin with, and you may not care as much about the dilution, the cash on cash returns for the later investments tend to be much better because the amount of money you can put in might be $30 million instead of $3,000. Once a company is more proven, limited partners and big funds will fight for pro rata rounds and pay you carry and pay you management fees to invest that pro rata for them. And you're not waiting 10 years for liquidity. The later rounds, it might only be 2 years away from liquidity. So pro rata can be quite valuable. It also keeps you more plugged into the company. You keep a closer relationship with the management team. They have to let you know what's going on. And if there's a down round or a washout round, it lets you have more senior stock that can at least protect some of your holdings in a wipeout scenario. The best deals tend to come out of your network. There tends to be people that you've known and trusted for a long time, and especially early on, it's notoriously difficult to invest in one of Elon Musk's companies. Even in very high price rounds, trying to get into a SpaceX or into a Neuralink is nearly impossible because all the people that Elon has made money for in the past all swoop in, get first rights, and they always take up the full allocation. If you're getting invited to one of Elon's rounds and you've never met him and you've never made money with him before, you almost have to wonder if he's run out of all the other friends that he had. The urge to go out and hunt for deals will actually lower your returns. Some of the best angel investors make their early wins by investing in people and spaces that they know really well, that are tightly and closely within their network. And it's only when your network is exhausted, but now in exchange, you have a reputation and you have more capital because you've made some money and been successful investing in your network, that it makes sense to start branching out because now you have reputation, capital, and know how. Without those, it's very dangerous to start going investing in spaces that you don't know, in people that you don't know, and most dangerously, into deals you're invited into by strangers. Because you can bet that if they're inviting a stranger, they've already exhausted their network of close allies and comrades. Most of what we say here is consensus knowledge or wisdom. So experienced VCs are going to listen to this and say, duh, of course, obvious. It's not designed for them. But at the same time, the real money in this business is made by being non consensus and right, being correct when everybody else disbelieves. And this happens all the time. For every deal that Sequoia does, it's possible that Benchmark or Andreessen or somebody else passed on it. For every deal that Andreessen does, maybe Sequoia didn't want to pay as much or they passed on it. There is a large universe of investment grade deals that even the top VCs don't agree on, the top angels don't agree on. And many of these go on to be successful. And then there are the consensus deals that all the top VCs agree on and try to pile into, and sometimes those end up being flameouts. One place where we recommend not learning how to angel invest is from journalists and from the average commentator on Facebook or Hacker News or Twitter. These people may be well meaning, but they don't know what they're talking about. Everyone piles into Theranos as an example of value excess when really Theranos wasn't backed by any good value investors. It raised all from out of market investors for very good reasons. And it was run by a founder that was built up by the media to be the next Steve Jobs because they were looking for a heroine. The media built her up and the media took her down. That deal smelt bad to any sophisticated investor from a mile away. They've been hating on Mark Zuckerberg and Facebook since the start, and yet here it is, a company worth several $100 billion and everyone surrounding it is fabulously wealthy. What Facebook does for society may be a different conversation, but the fact that it's a successful business is undeniable, and the fact that journalists have been calling for its death all along is also hard to deny. In this business, if you want to be successful, you really have to make up your own mind. You have to work as much as possible from first principles. You have to ignore the herd. The larger the herd you listen to, the worse your returns will be. If you want to go with the average consensus and average thinking, you will have average returns. And average returns right now are 1% in treasury bills.
We've spent the last few episodes talking about why you should be angel investing. We talked about how to get your own proprietary deal flow. And the short answer on that was build a brand. Now we're going to talk about judgment. How important is it? How to develop it?
Long-term judgment is absolutely critical because without judgment, you'll end up with a bad portfolio. You won't have other investors backing you. You'll lose your money and your brand will suffer. Good entrepreneurs won't want to be associated with bad judgment. At the end of the day, judgment is actually the single most important thing. It's more important than access to deals. It's more important than access to capital. The problem with judgment is everybody thinks they already have it. So your own judgment is subject to your own judgment. If you have poor judgment, then you won't know you have poor judgment. This is called the Dunning-Kruger effect. It's also common sense. People who are not that intelligent usually don't know they're not that intelligent. Some of it being an ego defense mechanism, some of it just being intrinsic to the nature of judgment and intelligence. So you don't know if you have good judgment or not. Furthermore, you may have good judgment in certain areas, certain verticals, or you might have good people judgment, but you may not have good market judgment. The only way to tell if you have good judgment is to look over a very long period of time. And unfortunately, in early stage investing, it takes 5 to 15 years to figure out if you have good judgment. The first thing to do is to be very honest about where your judgment is and calibrating it. And then there's a longer term plan we can work on to improve our judgment. Step 1 will be calibrate judgment. Step 2 will be improve judgment. Does judgment really matter? At the seed stage, it does matter, but it's much more about people judgment and product and market potential than being able to size up a cash flow stream, cost customer acquisition, or virality metrics, because you don't have that much data. As your judgment is lower, not because of some failing on your part, just because you don't have enough data, then you need a more diversified portfolio. In some sense, diversification is a hedge against a lack of knowledge. The less knowledge you have, the more you're going to diversify. At Warren Buffett's level, where you can examine an existing company that's been around for 20 years in great detail, you don't need to have a lot of judgment. You need to have a lot of diligence. Yes, judgment still applies, but you can pick one deal after having done lots of diligence on a whole bunch. At a seed stage startup, you have very little data. You may just be looking at other people's judgment around you. And this is why social proof plays such a big role. But at the end of the day, you're going to have to build a portfolio in early stage investing because nobody has enough data to have very high conviction or foolproof judgment early on. Parker Thompson, who had the Startup L. Jackson handle on Twitter, had a funny quote, and I think he was quoting somebody else on Twitter, where he said, "Everyone who invests after me is a spreadsheet jockey, and everyone who invests before me is a dart-throwing monkey." I thought that was very appropriate. It is the tendency to look at people who come before you as making wild guesses. That's what seed investors look like to later stage investors, and later stage investors look like spreadsheet jockeys to early stage investors. But they're just applying different levels of judgment, different kinds of judgment, because they have different data available to them, and they're going to then have different size portfolios and conviction because of the judgment they can and cannot apply.
How important is judgment given the amount of luck involved at the seed stage?
Investing at the seed stage is like playing the lottery, except that you can use your access and judgment to get one or two of the winning numbers in advance, which increases the odds, but you still need a portfolio effect. The better your judgment, the more numbers you know in advance. So it's absolutely still worth cultivating and honing judgment. This is a long-term game that will be played out over dozens and eventually hundreds of investments.
How much time do I really have to apply my judgment given how quickly deals move? Aren't I going to miss out on a deal if I take time to really think things through?
Judgment isn't necessarily diligence or even thinking. Judgment is all the preparation you did. So when the deal arrives, your subconscious can process it very quickly. I don't think the best judgment for early stage investing is done through extensive due diligence. Yes, it's smart to check references, talk to other people in the space, and think it through. But we're talking about something that takes days, not weeks. Over time, you will build up your gut instinct enough that you'll need less and less data to make an assessment. You'll know if a founder is speaking such a way that they're credible. You know if the network that they come through means that you don't have to reference check as much. You will already have established how customers in the space think and behave, so you'll have your own gut feel for what's really possible to sell them. A lot of startups are now trained, especially by accelerators, to run a very tight, fast fundraising process. They can pressure you hard to make a decision. The better investors are absolutely immune to that FOMO effect. If you push them hard, even on a really hot deal, and say, you have to decide within 48 hours, they'll always say, well, I don't decide within 48 hours, so it's not a fit for me. Done. Finished. They'll not look at it. FOMO works on many investors up to a point, but it will not work beyond a certain point on the absolute best investors. I have had to institute a 24-hour cooling off period rule for myself, which is even after I decide to invest, I force myself to wait 24 hours. One great reason to angel invest is it keeps you sharp. You see lots of bright companies, great founders come to you and they tell you in 1 hour what they've spent the last year learning. So it's actually an incredible way to get educated and to stay up to speed in the technology space. It's also a great way to learn about the nuts and bolts of all the different ways in which you could be starting a startup. You're doing a C Corp, but somebody else might be doing an LLC. You raise money from angels, somebody else went straight to VC. You did the 2-founder model, somebody else did the 5-founder model, somebody else did the 1-founder model, see how it worked out. A lot of the best founders actually end up dabbling in other people's companies as advisors or investors because they want to be good at everything. They know that long term, they are building the foundation for a skyscraper. And so they're going to be very careful laying down those initial beams and bricks. And the best way to figure that out is to talk to other smart people who have skin in the game that are alongside you. So first of all, it's just a great way to learn and to stay current. The best founders actually want to be backed by other founders. They want to know that the people they're taking money from know what it's like and have firsthand experience as opposed to secondhand experience. Very often, being a founder, especially on the angel side, will help you get into a deal whereas a pure financial investor may not be able to. Second is it's a good way to give back. Many great founders have the story of how someone took a chance on them early on or their first big break. Now you get to give other people their big break. You get to create the change that you want to see in the world by helping financially support it, by being an investor. It also helps align you. If you're the kind of person who's often driven by envy, which, let's face it, many of us suffer from envy, one great way to do is to align your interests. Now all of a sudden you're backing somebody and you want to see them win. Another good reason to do it is to teach. And what better way to learn than by teaching? You can share what you've learned and you get a chance to do that by being an investor. You can also do it as an advisor, but as an advisor, you tend to just own a lot less. And there's adverse selection to being an advisor. Very often, the best entrepreneurs don't need or take advice. So being invited in as an advisor to a company, sometimes it can work because of strong relationships and you have strong expertise. But just stamping your name as an advisor onto a company that barely knows you is not going to make you much or not going to do much for them either. Investment is often a very clean way to do it.
Is judgment overrated at the seed stage? Don't a lot of companies do soft and hard pivots?
Even when there's a pivot, the judgment about the people matters. And a pivot is really defined as keeping one leg in place and moving the other one around. It's not a jump. It's not a leap into a completely different industry. Oftentimes when there are pivots, they're into adjacent spaces, but you're still operating within the broader market. You will then overweight your team and execution evaluation and overweight that the market that they're operating in has enough room to pivot around, and maybe underweight the exact product approach. The valuation has to reflect that the company might go through some pivots, and the company's cash burn and cash planning has to reflect that it might go through some pivots. So again, judgment applies.
How is an investor supposed to know which companies to invest in given how much they can do a soft pivot or what I'm calling a hard pivot, which is same team but completely different market? Twitter originally started off as Odeo. Instagram started off as Bourbon. Slack was Glitch. Uber started off with just black cars. Lyft was Zen Ride.
I would argue that Uber's movement from black rides into shared rides wasn't really even a pivot, it was just an extension. Zimride's movement from long range shared rides to short range shared rides was also an extension and a very brilliant innovation on their part. So it wasn't much of a pivot. Audio to Twitter was a pivot, but it was a pivot from podcasting to microblogging from a person who had popularized blogging as we know it, F. Williams. So it was really a bet on a great individual staying very much within their space. It was a pivot, but it wasn't a jump. Bourbon to Instagram was barely a pivot. I'm not even sure I'd call it that, more of a step. If you look at Genie to Yammer, that was a jump, but that was David Sachs, who is one of the greatest product designers we've ever seen in the technology space. He was the founder of PayPal. He pivoted Genie into Yammer. He ran Zenefits, and he's been an incredible investor early on in some of the greatest hits that are out there. That was a David bet, like an Elon Musk bet, and the people who bet on David would bet on him again all day long. Another big jump was Glitch, which was a game company, to Slack. That was Stuart Butterfield. Even Flickr, his previous hit, had also been a jump of sorts. That's a case that I think was very unpredictable. People who invested in his gaming company invested in Stuart and just kind of hoped for the best, and Stuart delivered. But for every one of those, there's 10 failures. When you want to develop your judgment, the first step is to calibrate it. Do I have good judgment or not? Obviously, it would be great if you could just look at the data and say, was I correct? But you won't know that for 10 years, 15 years. And by that time, the industry will have changed. You may have been correct for the way the industry was 10 years ago, but this is an industry that evolves and adapts very quickly. Another way to do it is you can look at intermediate markups where Sequoia or Andreessen or Benchmark or whoever are marking up your rounds and they're coming in after you and paying higher prices. That's an interesting metric, although there it's really your taste in what other tastemakers like. It's a Keynesian beauty contest where each judge is being rewarded based on what the judge in the next round thinks. You're becoming a good arbiter of future taste. This does have some value because if you're good at predicting what the VCs are going to fund, then your companies will get funded. And through the funding, they're likely to have some competitive advantage and to win. But this won't help you when Bitcoin is first starting up and it's incredibly strange and nobody understands it and there's no subsequent round of VC funding to bet on. You just have to make the decision yourself. That kind of judgment is a people proxy mechanism. It's not really a way to build and calibrate your own judgment. When you invest, you can also look at what other investors are coming into the same round, but right behind you. If they're coming in front of you, then it's not a good proxy for your judgment because you're probably keying off of them. But if you invest in a round and then good investors who have proven good judgment pile into the round after you, then that is a reasonable indication of your judgment. Finally, you can just ask people. Don't ask them if you have good judgment or not, because they'll always tell you that you have good judgment if they're polite. But ask them where your weaknesses are. Of course, only ask this of people who themselves have good judgment. As an aside, I find that people who have good judgment in all aspects of life. Judgment is an ability to be humble, think critically, be well-read, have a broad range of ideas, hold conflicting ideas and opinions in your head, to have a relatively low ego so you don't get too attached to your earlier decisions, and be constantly questioning yourself, preferably have scientific training or a technical background, have worked in an industry where you have to deal with real world consequential feedback and not just what other people think of you, and the willingness to be unpopular. Clear thinkers think from the ground up and they use first principles in a lot of their reasoning, so they end up relying on their own authority. Things that will lead to poor judgment over time are groupthink, over socialization of judgment, picking things that you know are going to be politically or socially popular. Lots of people lose money in this business chasing things that they wish were true as opposed to what actually turns out to be true. The PayPal mafia is famous for being very insular. They all have good judgment. They're all strange. They're all very politically incorrect. Many of them are extremely unpopular, and they're not afraid to hold unpopular viewpoints, but they really respect and value each other's insights and judgment. Whatever people say about Peter Thiel, no one wants to go head to head in a debate with him because he's brilliant and he's contrarian and he's a first principles thinker from the ground up. If you surround yourself with people who are brilliant, contrarian, first principles thinkers over your career, you will develop extremely good judgment. You may not end up being very popular, however.
Do great deals even look that normal when they're first getting started?
It's the nature of the industry that you want to be non-consensus right. In other words, you want to be right when everybody else is wrong. If you're right when everybody else is right, you won't make enough of a return. And of course, if you're wrong, then you're not going to make any return. So the best deals are either weird or socially unacceptable or not normally considered part of venture or look far too niche to be interesting or are brought in by a founder that doesn't fit the normal founder mold or in a geographic location that doesn't fit the normal geographic mold or have some cap table problem. But the best deals always have something broken, strange, or different about them. That doesn't mean you're going to make the best investments if you only invest in weird deals. This is a little bit like that old saying that there's a very fine line between a genius and a madman. Both seem like crazy people from the outside until after they're validated. And 1 out of 100 turns out to be a genius, and 99 out of 100 turn out to be crazy. You have to be iconoclastic enough yourself to recognize the genius founders without being so low in judgment or being so strange that you're letting in all the crazy ones too. One could argue that the way portfolios are constructed, you're better off investing in a lot of crazy deals than you are in a lot of decent looking deals. To give a recent example, there's a fund started by Patry Friedman called Promonos Venture Capital. Patry is going out there and investing in experiments in governance, new city states or even new towns or localities, how people are taking local government into their own hands or doing experiments in governance. This seems impossibly difficult to do. The history with seasteading in Honduras doesn't look that great. But all you have to do is stumble into the next Singapore or Hong Kong, whether it's virtual or physical, and you have something that can create trillions of dollars in wealth, plus completely change the way that people live their lives. That's an example of a fund that is doing very difficult and strange investments. They benefit from two things. One is they're going to have a unique brand. There's nobody else doing that, so everybody knows to go to them. And second, they're going to bet on the kinds of things where the vast majority of their investment are going to be looked upon as mad investments, but the few genius outliers should return huge returns because they're non-consensus investments. Similarly, Founders Fund and Steve Jurvetson build their brands on being willing to fund weird things long before anybody else. It's very easy to overestimate your own judgment. It's perfectly okay to say, I don't know. Most of the times, your answer should be, I don't know. There's only a few times where you should say, I have conviction. And even there, you want to be very careful about how much conviction you have. At the seed stage, if you are putting a lot of money into one company and very little into another company, that begs the question, what exactly are you doing? Do you really have conviction in the one? Or do you just have a lot of access in one deal and therefore you're putting in more capital there? Generally, the better the deal, the less access you're going to have. If you end up putting a lot of money into a few deals, and then very little money into many other deals, you'll find that your winners tend to come disproportionately out of the deals where you have very little money, which hurts your portfolio return. Once you have conviction, always try to get your standard bite-sized chunk into that deal. If a deal has too much space for you, then that either means you should be investing more in the other deals, or you should be investing less in this one, or you should be getting rewarded through a lower valuation because you're creating the signal than the company is actually going to use to raise the bulk of the money. Anyone in this business who's chasing hot markets gets killed. There was a time when consumer social was the hot market. If you started investing in seed stage when that market was hot, by the time your companies matured, that market was done. Same way, once it became obvious what Uber was and it was winning, if you started investing in the masses of food delivery companies that showed up, numbers 5 through 50, and there were a lot of them, you lost your money. Today, SaaS is the proven moneymaker and very hot. Let's see how it plays out. Probably 5 to 10 years from now, when your current seed stage SaaS investments hit the market, you'll find the returns are a lot lower. It's good to be at the beginning of a market, not at the tail end of a market. By the time there are conferences about it and TechCrunch is writing about it, it's probably a little late. Same with crypto. If you got in 2017, you were actually the tail end of the market. The early side of the market was in 2009 to 2015. There are multiple ways to build judgment. The timeless kind of judgment, good decision making and sizing people up, a lot of that comes through experience or reading great works and books that intersect science, business, philosophy, and cover how very smart people think, building up so-called mental models, understanding microeconomics, game theory, etc. Within a field, you can build specific knowledge that's timely. The way to do that is to dive into that field and learn everything as quickly as possible. You're not going to become a great tech investor by reading TechCrunch or Bloomberg News. You're going to have to go to the source, and the source is often research papers. You have to genuinely enjoy the act of learning science and technology. Technology is applied science, so you shouldn't hesitate to read scientific papers, brush up on your mathematics, and make sure you understand what's going on in the scientific journals. Similarly, you can start out by investing in the smartest scientists in the space, knowing that even if they don't necessarily make you money, these are the people that will perform due diligence for you, and perhaps you'll make them advisors to your fund or give them a small piece or let them co-invest if they have the means. They'll actually validate and calibrate things for you, and they will also send the best scientists your way. For example, early on when I was investing into cryptocurrency companies, I became friends with Zuko Wilcox Hearn, who started Zcash, and Juan Binet, who started Filecoin, and Ryan Shea and Munib Ali, who started Blockstack, and also Eli Ben Sassoon and Andrew Miller, Bram Cohen, creator of BitTorrent. These became my go-to people for vetting and validating deals. They would tell me which technologies were real and which ones weren't, and which scientists were credible and which ones weren't. Being surrounded by good technologists and scientists is a secret weapon because you'll get referred in through their networks. And these people tend to be no bullshit. They'll tell you exactly what they think of a new technology. You do have to use your own judgment to calibrate when they are being unnecessarily negative or when they're being jealous because it's just human nature. But usually, very technical people tend to be extremely objective because they're used to corresponding with the real world and scientific results and not necessarily with other people who are more influenced by subjectivity. If you can find a group of painfully honest and distinguished scientists and technologists to connect with, that will be a secret weapon throughout your investing career. I use the Warren Buffett 3-part test of who you want to work with: high energy, high intelligence, and high integrity. High energy is obvious. You have to work hard because startups are the Olympics of business. You're competing against the best in the world. First prize gets a Cadillac Eldorado, second prize gets steak knives, and third place gets fired, to paraphrase Glenn Ross. And if you're going to win, you need people who are putting in everything, and that includes working hard. There's this meme on Twitter that you should just work 9 to 5 all the time, and that's work-life balance. That's perfectly fine. Not everybody should kill themselves at work, but I would argue that you should not be an Olympic athlete, nor should you be a founder of a winner-take-all technology startup. Avoid the virtue signalers and status seekers and realize that if you're doing a startup, you're going to have to work your tail off. And everyone around you in that core team is going to have to work their tails off. You need very high intelligence people because intelligence isn't just about broad judgment. It's about moment-to-moment judgment. If they're making decisions and they're high intellect, then they'll make the right decisions. And you have to have a high bar for intelligence. You want to be a snob. Don't invest in people that you don't think are in your intellectual caliber. Otherwise, you're investing down, talking down, thinking down. You're picking the wrong people. High integrity is critical because if you don't have that, then what you have is a smart and hardworking crook who can easily cheat you. And there's so many ways to get cheated in this business. That said, integrity is something that takes a long time to figure out. It's very hard to tell who is high integrity and who isn't, unless you've worked with them a lot before, which you will not have for most founders. But you can see how they treat the other people around them right now. You can see how they treat other prospective investors. You can see how they think about their co-founders and their employees. Someone who is already self-dealing is going to eventually cross you. They don't necessarily need to be nice people because niceness is a signal that's easily faked. A lot of highly technical people tend to know that, and so they don't overemphasize niceness. Niceness is everywhere. It's not enough of a filter. It is important in the sense that maybe you don't want to work with somebody who's not nice because it's just less enjoyable. But there are plenty of people in this business who are not nice and have been successful. High integrity is what you want. Integrity means having some sort of an internal moral code of ethics and living up to it, being reliable and being honest. Whereas niceness is often just politeness or sending off small signals of being high integrity when there's no actual consequences or when the stakes are very low. Integrity gets tested when the stakes are high. With every deal, you can give it one fatal flaw. One thing that some established traditional venture capitalists will look at and use that as an excuse to not fund the deal. But if there's more than one, then you have to worry. Startups are rewarded for innovating on something new. If they're trying to innovate on things that already exist and work, such as team structure or founder mentality or those kinds of things, they're just taking on additional risk. You have to use your judgment to figure out where they can break the rules and where they have to follow the rules. A startup that follows all the rules is unlikely to be interesting. A startup who breaks all the rules is not going to get anywhere because they have to spend time reinventing everything from scratch. Uber, when it first came along, was strange because at the time, VCs did not invest in offline industries. It was considered the taxi business. Yes, there's an app stitching it all together, but looks like the app is 5% of it, 95% of it is people in cars driving around. And they were correct. But the question is how much that leverage can accrue to the person who owns the app and how much they can expand the market because of the app by creating new products and bringing on new users and creating convenience. Google was strange because everyone thought the search wars had already been won by the time Google showed up. It really helps to understand technology, to understand which rules to break. The best position to be in as an investor is when somebody shows up and the technology is too difficult for other people to calibrate or understand. So therefore they pass on it because they don't think the technology is feasible, but you have enough technical insight that you know that it is feasible. Then you just have to make sure that you can get it funded to the point where it's obvious to everybody. The value there comes in breaking a rule that you know is not really a rule to be broken, but everybody else thinks it is. One common trap, especially for former entrepreneurs, is you'll look at a company, you won't really listen to the founder pitching it. Rather, you'll be fantasizing about all the things that you could do with this company. And you'll be taught the painful lesson that no, it's actually not you who's running the company, it's the entrepreneur running the company. It's important to listen very carefully and take the founder at their word as to what they're saying and what they want to do, and not get caught up in this idea that somebody else is going to run the company. This is the exact opposite of value investing. Buffett basically says, invest in a company that even a fool can run because eventually a fool will run the company. That's not the case with startups. Almost all the value creation happens while the founder is intimately involved in most of these companies. So you're betting on the founder. If you bet on a founder that you're not that excited about with a market or product that you are excited about, the founder will often fumble the company, or often you will have just invested in this company and then a competitor will come along with a much better founder. And now you're blocked out or conflicted out from investing in the new company. Or the new founder doesn't even want to talk to you because they know you invested in the competitor.
Why don't we break down judgment and talk about how it applies to investing in teams, evaluating the product and the market, looking at their traction, and also evaluating any social proof around the deal. So we're going to break up judgment into team, product and market, traction, and social proof.
This is a technology business, and you want to be investing in technology teams. That means every great team is highly likely to have a great technologist as part of the core founding team, if not as the most important member. That person has to be sufficiently compensated and motivated and has to have their name and accountability involved in the project. If that strong technical person isn't there, either you're not investing in a tech business or that function has been outsourced and the company doesn't consider it core, which is not just a yellow flag, it is a red flag. It's not to say you can't make money investing in non-tech businesses, things like Dollar Shave Club, but I don't consider these to be technology companies. There are plenty of great non-technology investments. Chipotle is an example of a great non-technology investment, but that's not what we're talking about here. So you want to invest in great technical teams. People who aren't highly technical but on the founding team should be incredibly good at selling. If you're not building something, you're selling it. And you're not necessarily selling the product to the end users, although that's the common case. You're also selling to investors to raise money, and you're selling to potential employees to recruit them. So there's building and there's selling. There is a potential third kind of character who can be incredibly useful, and that is a community builder. But a community builder is actually just a seller. They're good at mass sales instead of one-on-one sales. Great community builders are incredibly rare. They're probably the rarest thing right now. They're very high leverage, but they're extremely difficult to find. Everyone claims that they're good at it, but you want to see the results. If they haven't already built a great community, then you have no evidence that they are a great community builder. There's this meme among venture capitalists that a good founder should be coachable. I think this is a meme among amateur venture capitalists. They're relying too much on their own abilities because they think they're right and the other one's wrong. And they're also relying too much on this idea that people can be changed in the short term. Great founders are actually not that coachable. They listen to lots and lots of advice, but they actually follow very little of it. Most great entrepreneurs have their own internal compass. So I believe that coachability is an overrated metric. The default scenario for an angel when they start investing is that they tend to be on the tough side, especially when it's their own money involved and they're investing a lot of it. Generally, you don't want to put in money into any deal that you will care about if you lose it. If you have so much money in a deal that it will really bother you if you lose it, it will cause you to engage in bad behavior with the founder if things get rough. And your reputation gets built in those moments. Your returns get built by the companies that are doing well. Your reputation gets built in the companies that are doing poorly. Your long-term returns, which are also based on your access, have as an input, how did you behave with the founders when they were doing poorly? As a consequence, you never want to have too much at risk. If you have too much at risk when the company is doing poorly, you will behave poorly. Emotionally, you won't be able to help it and it'll damage your reputation. So don't put down so much that you care. This is a game of exceptional outcomes. It's not a game of averages. You're better off with a portfolio where 9 out of your 10 investments go to zero and the 10th one goes 1000x than a portfolio where all of them are 2x, 3x. One strongly negative indicator in this business is if a team hints, signals, or just appears like they would sell the company early. If they're overly financially motivated, it's very common for a team to sell a company for $100 million or $200 million, which is a great life-changing outcome for them. But for you as an investor, it doesn't matter much because you own so little and it's going to not move the needle on your net worth. This is why VCs tend to look for not just home runs, but grand slams. As Bill Gurley famously said, this is not even a home run business, this is a grand slam business. People are always looking for the extreme outliers. The smart VCs know that. When you invest in companies where the founder is going to sell early, you miss out on the benefit of compounding interest. Also, other VCs downstream will be very good about reading that signal. So they will pass on that deal and will be unable to raise the cash to become a big company. There's not much of a way to pull that signal out of founders, but sometimes they offer it. This is also why really great VCs these days will let founders sell some secondary early on, take some money off the table in exchange for going for the gold. There's a set of angels who insist on checking references on founders. This can be good if you know what you're doing, but reference checking is an art. It is something that most people do not know how to do well. Founding is an act of creativity. If you were to reference creative people in history, great writers, great philosophers, or great artists, most of the references would tell you that the person is crazy. The honest ones would. Founders are non-fungible. They're not replaceable. A founder that may be great for one business may be terrible for another business. The founder who's really good at building a Craigslist where they have to be very community-oriented, extremely patient, and almost anti-capitalist would be an inappropriate founder for a financial startup that's on a race and has to raise and deploy lots of capital and pitch banks and regulators. So it's the right founder for the right job. References tend to be more generic in their nature. They tend not to work as well on the founder side as they might on the employee side, where you're looking at someone to scale up some process that's already working. I passed on Twilio in the seed round because of a reference. Big mistake. It was a reference from somebody I trusted who was well-intentioned. It was probably even accurate, but it didn't matter for Twilio. I should have just gone with my own gut feel that Jeff Lawson seemed like the right founder for the right job. Also, I passed on Ethereum very early on because of a negative reference. I did clue into that later, but early on, I had a venture capitalist who was very active in the space give me a reference on some of the Ethereum founders that dissuaded me in a way that it shouldn't have. References from VCs are among the worst references because for every deal that a VC ends up doing, there are other VC firms who have passed on that very same deal. So there are a lot of deals that Sequoia will do that Andreessen passed on and vice versa, and this goes up and down the chain. It's not even the case that the best deals are always chased by the best VCs. Everyone has their own unique point of view in this market, and the good players have very independent points of view. So you have to develop your independent point of view. And references either devolve into checklists where, okay, I better just check the box that I've done all these references, or they end up in groupthink, where if you're actually listening to them, then your point of view is being diluted by what these other people think into a smeared average. The thing you really have to check with a first-time founder is, are they going to adapt and grow on the things that they don't know? Are they going to be able to lead a company? Are they going to figure out how to be a CEO? This doesn't necessarily mean, are they coachable? It's more, are they motivated to learn those things and are they fast learners? On repeat founders, what you have to test much more for is passion, which is, do they really want to see this thing all the way through? When the going gets tough, are they going to just drop it and go start the next thing, or are they going to stick with it? Do they have conviction, is what it boils down to. And do they have the humility to go through the beginning all over again? Many times, repeat founders don't really want to start over. They don't want to start with a team of 4 or 5 people in small wooden desks huddled in a small space. They want to start with a lot of money. They want to start with a big bang, with a big office and a big team. And that can work where the risk is more execution risk, like it often is in enterprise sales and software, but it may not work where it's invention risk, which is what you get much more with consumer social networks or with deep technology development.
It seems like the first time founders are taking out the market risk, which is why they tend to have the biggest outcomes, but also most of them fail because they have a market insight that they're attacking. And the repeat founders are taking out the execution risk, which is why they're probably much more consistent in the results, but the results aren't huge because they're not betting on a market insight.
That's a very deep point and a good way of summarizing it. First time founders take on market risk and create new markets as a result, or own entire markets. And repeat founders take on execution risk. And then there's some blends. For example, when you're developing a new technology, that technology can create a new market. It requires deep expertise, tends to favor first time founders in that regard. But technological development also requires raising lots of money and addressing things like manufacturability and distribution of brand new things. And sometimes that takes a repeat founder's resources. There's a sweet spot which sometimes shows up, which is a repeat founder who had a success before, but not so large that they lost the first time founder mentalities. For example, let's say that you have a team of people that was building robots and they failed because they were too early. They made a really good attempt at it. They had very little money. They couldn't really get over the hurdle and the market wasn't quite ready. If you see that team come back and they still want to build robots, but now they say the timing is right, they've brought on a few younger people who have access to the new technology. Now they can raise more money and they've got a big chip on their shoulder and they're determined to prove that this space can work. Those kinds of bets can be very interesting.
I don't want my post to be interpreted as a criticism of blitzscaling. This is meant to be a companion piece. It's often necessary and desirable to blitzscale. The idea behind blitzscaling is that you want to be the first scaler. The startup that wins the market isn't necessarily the first mover, it's the one that's able to achieve scale first, because that's when a network effect kicks in or some other economy of scale. It's better for a startup to risk a blitz fail than never to blitz at all. Commoditization is the reason why you can't seek to avoid blitzing at all. Commoditization is what happens when the rest of the tech ecosystem catches up to a startup's innovation. As you're getting commoditized, the startup will find that its pricing power is undercut, or even worse, its functionality is simply assimilated by a larger player. You discover that what you've been working on is not a product, but a feature of someone else's product. In that sense, it's unlike all the other problems in that the startup isn't causing it. It's something that happens to it because it's not moving fast enough. Commoditization is the one item on the list that would argue for moving faster, not slowing down. So it's incumbent upon a startup to stay ahead of the competition and to develop network effects or some other advantages of scale before the commoditization can happen. And that pressure to be the first to scale is what causes all the other problems. The founder internalizes that pressure and may engage in premature scaling, or they may blitz at the expense of a lot of other things. I compare it to a high performance sports car that dangerously redlines. A startup should try to go as fast as possible, just not faster. And the point of this piece is really to identify the governors on growth, the things that are going to cause their engine to overheat. In between kind of these once a decade shocks, we have mini shocks that can affect certain kinds of companies or certain stages where you get a reevaluation of the fundraising criteria. You had the SoftBank shock, which was a mini shock in late stage rounds where all of a sudden people were starting to reevaluate late stage valuations for certain kinds of companies. One of my biggest learnings since I've become a full-time investor is that micro bubbles are constantly occurring as spaces fall in or out of favor with VCs. When a space is in favor and hot, all the normal rules of investing get thrown out the window. For example, we had a crypto bubble over the past 2 years. Crypto companies with no revenue, no customers, and even really no product yet, we were able to raise at stratospheric valuations. You had some tokens raising pre-launch in the billions of dollars in valuations. If any of the normal rules of investing would have applied, the valuations would have been a lot lower. When the space gets really hot and the narrative takes over, people buy into the narrative, the valuations go way up, companies are able to raise a lot of money. But then once the bubble pops, all of a sudden the normal rules of investing do apply and the valuations plummet to a level that's implied by the fundamentals, by things like customers, product, and revenue.
Hey, this is Nivi. I'm here with David Sachs, one of the mentors at Spearhead. He recently published a popular blog post called Blitzfail, which is about all the ways that a scaling company goes off the rails. What motivated you to write this piece in the first place?
There's a lot of content out there for founders on how to find product market fit or how to scale, but there's not really a lot out there explaining how not to go off the rails once they do find product market fit. Every year we see promising startups that have product market fit that just derail. It happens very quickly. And it can even happen on the verge of an IPO. You have a company like WeWork that's filing an S 1 week, and 3 weeks later, it's potentially filing for bankruptcy. Are each of these derailments a unique event, totally bespoke? Because that's the way it's portrayed in the press, that each one of these things is this sensational story. But there's a lot of common denominators between all these startups that go off the rails. It's not this random thing that happens. It happens recurrently. And the frequency with which these things happen makes them an epiphenomenon of Silicon Valley. The post is an attempt to drill into what are the common reasons why this happens and why are these issues missed. It's easy to point out where startups go wrong, but why is it that these issues seem to sneak up on people? The reaction I've gotten to the piece, there's a lot of tweets where people say, yep, I recognize that. That happened to me. This was cathartic to read this. Or, yeah, we had numbers 4, 7, and 11. So it seems to be resonating with people. A lot of founders and employees see it as a mirror for their own experience, which is gratifying for me to see. At the heart of most rail jumping behavior is founder psychology. You've got a founder CEO who pushes things too far, not even on one dimension, but typically on a whole host of them. When you read the accounts of spectacular blitz fails, the founders are always described in a very similar way. They're described as running through walls, crazy, aggressive, visionary. Those are the adjectives that are always used to describe founders who've come off the rails. When things are up and to the right and everything's positive, people use those adjectives in a positive way. It's not until the startup goes off the rails that all of a sudden crazy goes from meaning something good to meaning something bad. So the question is, well, how can you tell the difference between good crazy and bad crazy? Founders do need to have these qualities of being visionary, of being aggressive, of even being quote unquote crazy, because you do have to be far more aggressive than the average person. There's no question about that. The world does not follow a normal distribution. We like to think that there's this perfect kind of Goldilocks amount of aggressiveness that a person should have. It's like the mean amount. But the reality is that the world rewards aggressiveness far more than what a quote unquote sane person would think. While the startup is up and to the right, the founder is getting all this positive reinforcement that these crazy, aggressive, visionary traits are working. It becomes this positive feedback loop urging them to go faster and faster, further, until they go off the rails and have this jump the shark moment. What you'll see with the companies that frequently go off the rails is that the warning signs are dismissed. It's almost like no matter how outlandish the behavior, as long as the company is growing, it must mean that the founder has discovered some hitherto unknown secrets of company building. The fact that the company is growing is taken as proof that this new culture is some brilliant new way of doing things. And in fact, what's actually happening is that a time bomb is building because the culture of the company is becoming self-reinforcing to the point where it's headed for some derailment.
There's a constant running debate between first-time founders versus repeat founders. There's no hard and fast answer to this question. Probably most of the value in the industry is created by first-time founders. Larry Page and Sergey Brin, Mark Zuckerberg, Jeff Bezos, lightning strikes, thing catches fire, off it goes. Even some of these so-called first-time founders, though, aren't necessarily first-time founders because Mark Zuckerberg had other projects that didn't work before Facebook took off. Similarly, Bill Gates, I believe his first company was Trafo Data, measuring traffic going down the street and selling that data to municipalities. He was doing that with Paul Allen long before he did Microsoft. So very often, even what looks like a first-time founder is a person who's been tinkering for quite a while. Repeat founders can also be extremely successful. If you look at companies like Zoom and WhatsApp, these companies are founded by repeat founders. Uber was founded by repeat founders. Repeat founders tend to be much better at execution. They tend to be better at recruiting teams. They're generally more careful about what markets they enter. They tend to be a little less passionate about whatever they're working on because they have surveyed the market and picked what they think is going to work, not necessarily what they're super excited about. They tend to have less specific knowledge about the field because they haven't necessarily been buried in it for the last 10 or 20 years. Although sometimes you do get that effect with people coming out of a bigger company where they've incubated some technology that they really like. The deals tend to be higher priced, so your returns are lower. They have better connections, so they can raise money more easily. The integrity test tends to work better because you're more likely to have a longitudinal relationship with this person. There's just a different set of trade-offs. I don't have a hard and fast rule about don't back repeat founders or don't back first-time founders. I found both can work and both cannot work.
In the same way that I recommend that founders seek to balance their own psychology, they should seek to balance the psychology of the hive mind, the corporate mind. There are a few ways of doing this. It starts with choosing the right co-founders. The strong founder will naturally have a blind spot to their worst traits. We all do. And so the best company cultures are usually the result of a yin-yang relationship. A famous example would be Apple. You've got Steve Jobs bringing the maniacal drive and vision, and Woz brings the heart. It's really good for companies to have a Woz. The values must also mature over time. What works in the early stages, some of these catchphrases, they don't work at massive scale. Facebook changed its famous motto, move fast and break things, to move fast and build scalable architecture, because at massive scale with thousands of employees, some of these catchphrases can be misunderstood. They percolate down to junior employees who are left to wonder on their own what they might mean and come up with interpretations. You've got HR reports from all over the company of employees engaging in behavior that seems reckless or short-sighted. So you have to mature your values over time. It's smart for founders as the company grows to create more structure around HR and culture. So you do things like adding formal onboarding programs and training. You survey employee happiness. You stress the virtues of operating with integrity, because growing without structure creates chaos. One of the toughest things about being a founder is that you're locked in a Darwinian struggle with your competitors, and simply moving fast may mean that relative to the competition, you're not moving at all. It's like the Red Queen in Alice in Wonderland says, it takes all the running you can do just to stay in the same place. Founders not only have to move fast, they have to move incredibly fast to stay ahead of the competition. The goal with any venture-backed startup is to create a unicorn, but to create billions of dollars of market capitalization within the 5 or even 10-year window of a venture fund is an incredibly hard thing to do. And it's that constant pressure to move faster relative to competitors that creates some of these pathologies of hypergrowth, where you are growing faster than you should because you feel this incredible pressure to escape the hamster wheel that you're on. If a founder waited to do everything perfectly, if they were to run their business in this incredibly efficient way, if they didn't feel the pressure to grow faster, then they could easily avoid all these problems, but they would still lose because they simply weren't growing fast enough. I published this piece about a week ago, and number 11, the last one, is Macro Shock Meets Unprepared Company. Sequoia just published that coronavirus is the black swan of 2020. It feels like we're about to go into one of these periods where once or twice a decade, you get some macro shock that hits the startup ecosystem. Fundraising either drives up completely, or you get a reevaluation of the fundraising criteria. The startup that is unprepared for that gets caught flat-footed. If you have a high burn startup that meets a macro shock, that's frequently a cause for blitzfail. You thought there was always going to be a bigger, better deal out there, and you raised your burn accordingly, and then all of a sudden you have a macro shock. That's the recipe for running out of money and dying. Since I've been in Silicon Valley over the past 20 years, we've really had 2 of these mega macro shocks. The first one was the dot-com crash that started in 2000, but really went on till about 2002. Fundraising dried up. It was just about impossible to raise money. PayPal did, but it was really hard. We turned over a lot of rocks. And you saw companies slowly run out of money and die. There's a website called fuckcompany.com that memorialized these startups just running out of money and dying. In 2008, 2009, you had the real estate crash, which caused the Great Recession. And it wasn't directed at startups specifically or the venture asset class. It wasn't our asset class this time that was troubled or toxic. But for a time, it depressed valuations and made it much harder to fundraise. One takeaway for founders is to always make sure they've got a sufficient cash cushion to weather a storm. And if it's necessary to cut burn, do it as soon as possible so that you can start to benefit from the additional runway. Because the sooner you cut, the more runway you get on the other side. The simplest way to understand company culture is as a macrocosm of the founder psychology. So if there's a founder psychology problem, it's going to be writ large across the company. This will happen even if the founder has a reasonably balanced psychology. Their strengths, weaknesses, internal struggles, whatever's playing out in the founder's head is going to percolate down into the company culture. This is true for good company cultures as well as bad ones. Sometimes there's a mix of both. Take the early Microsoft culture, which was incredibly competitive. It's a result of the fact that the founder, Bill Gates, was hyper competitive. You've seen the classic Microsoft org charts where every business unit is pointing a gun at some other business unit. This is the result of the founder being hyper competitive. If the founder is corporatist, which I've also seen, usually not founders, but more higher gun CEOs, the culture all of a sudden becomes very stuffy and hierarchical and political. If the founder is belligerent and likes to fight, the culture becomes hyper aggressive and likes to fight and will find themselves in lawsuits or wars that it didn't necessarily expect to be in. If the founder dithers, if they can't make decisions quickly, the culture will feel adrift. Whatever the founder's traits are, the culture will take on those traits. And the reason is from the beginning of the company, the founder's behavior gets role modeled. It happens both through subtle cues. You have the cult of the founder where the employees feel like, well, this is the way the founder behaves, so this is the way things are done. But it also gets reinforced through overt rewards. The founder will codify their values into catchphrases, which are then promoted throughout the company. Frequently, these catchphrases can seem to be exhorting undesirable behavior. You'll see catchphrases saying we should break things or we should fire before we aim. In shades of Animal Farm, the founder will actually explain why these are good things, not bad things. So you will get this cultural reinforcement of these founder values. What I've tried to do in my discussion of the core metrics, unit economics, CAC, and churn, is to explain not just what these things are, because I think people know, but rather why companies are caught by surprise, even though these issues are so well known. It's very easy to understand why negative unit economics are bad. Negative unit economics occur when you sell the product for less than its variable cost. Nothing will give a startup the illusion of success like negative unit economics because you're selling dollar bills for 90 cents. It's easy to grow very quickly when you're doing that. The question is, why are startups caught by surprise by this? And the reason is because it's actually hard to measure in a lot of cases. Startups are losing a lot of money. They're all losing money. And unless you correctly attribute your spending between corporate overhead and then cost of goods sold, you won't actually know that you have a unit economics problem. And so it sneaks up on companies. This is a problem that most commonly afflicts tech-enabled startups where, yes, there's a software component, but there's also a physical world component. You could have a delivery company and it believes it has product market fit because it's growing very fast. It expands into multiple cities, but the finance function is very immature. So they don't have all of their costs properly attributed. They start to hire a finance team. The finance team is making noises. Well, hold on, the gross margin picture is unclear, but the founder is in a race against 4 other companies. And so they've got to move quickly. Why don't you guys figure out what's going on and then get back to me? And you're already operating in about 50 cities by the time you realize that you have negative unit economics. Then because you're already operating at massive scale, you have to do a brutal restructuring. In the ideal world, you wouldn't expand into multiple cities until you knew that the first city was contribution positive, but competitive pressure makes you feel the need to expand sooner. VCs are now competing with each other to see who can be the most pro-founder. You have a situation where no one really wants to give the founder tough advice, tell them they're doing something wrong, give them any tough love. And in fact, founders of fast-growing companies get to pick their board members. The whole ecosystem is pro-founder. That's as it should be. But the smart founder will go out of their way to ask people what they think, to ask board members who might be a little reluctant to tell them what they really think. So many founders are starting from a position of distrust with respect to their board. It's like Hollywood, where the talent just became incredibly suspicious of the business side. The thing that every director wants is final cut. They want complete creative freedom. That mentality has spread to Silicon Valley a little bit, where there have been enough founders who've been burned by VCs that they just want total freedom. My view is that it's the founder who should make the ultimate decision in all these companies, but the smart founder will seek out experienced advice. And this auteur mentality that's spreading will only harm the founder to the extent they don't seek to go out and balance their psychology and get that advice. There's a temptation for founders to pick board members who will either just be cheerleaders and be completely compliant and just root them on, or to choose people who are exactly like them. And if you do that, you go for the mirror image, you will square the insanity. You'll just be feeding on each other to keep going faster and faster without asking deeper questions about the business. Founders need to be self-aware enough to balance their own psychology. A lot of founders don't really even see the desirability of that. They don't really want to balance anything. They feel like having board members who are balancing could only thwart what they want to do as founders. And it's not true. There are board members, advisors, mentors out there who are aligned with what the founder wants to do and won't seek to thwart them, but can nevertheless provide some good advice so that the founder can maintain perspective. One of the problems with crazy is that crazy doesn't listen to sane. That's why in a lot of cases where the company tries to compensate for a founder psychology problem by surrounding the founders with sane people, is that it frequently doesn't work because the founder still doesn't listen to sane. My advice will not fix a problem where the founder truly is psychologically unbalanced, but there's a lot of cases where the founder is able to be self-aware enough and is able to be balanced enough if they get the right advice. The mistake I see a lot of founders make is the problem of happy talk. Founders want to hear the good news. They want to believe. I'm in a board meeting with a founder and trying to explain to them things aren't really going that well. And the amount of proof they demand from me to convince them of this is sometimes extraordinary. Whereas the burden of proof for proving anything positive is very low. It's really important for founders not to wait until their backs are against the wall. I was doing Genie in 2007. It was a family social network, and we got off to a really hot start, but then I saw Facebook open up beyond colleges, and it was really clear to me that they would just eat family social networking. That wasn't absolutely proven. It would take another few years for that to be proven out. And there were a lot of people on my team who said, no, families will never join Facebook. But it was pretty clear to me that the writing was on the wall. So we didn't wait for that to happen. We made this pivot into corporate social networking, and we did Yammer. So I think it's important for the burden of proof to be somewhat consistent in trying to get you to see a problem as it is for you to see hope. This ability to properly attribute costs is a muscle that startups need to develop, but they typically underdevelop because there's this rationalization that the startup can optimize margins later. After all, the most important thing is to find product market fit. Then we have to beat the competition. Profitability is something we can optimize for. That's generally true as long as there are profits to be optimized. The problem is when you discover at a very late stage that there aren't any profits because the company has negative economics, and then you're in this mode of needing to find the scalable model when you're already at scale, which is a contradiction in terms and leads to the brutal restructuring. Very extreme case would be something like WeWork, where they get all the way to the point of filing an S1, and it's not until they do that that they discover that there might be a giant unit economics problem, and 15,000 employees is just way too many for the kind of business that they have. It took public investors to send the message to them that the unit economics weren't working. Public investors scrutinize unit economics much more closely than early stage investors. The reality is venture investors don't have as many data points. We're just trying to find ideas that seem to be working, that can work very broadly. And then you've got growth investors who are somewhat in between. There's more data, they look more closely at it, but they're also looking for fast growth. They scrutinize things a little differently than the public markets. A startup needs to raise its bar financially with each round. When you go out to raise your seed, you're not going to have any financial information. You raise your Series A, you're going to have some. By the time you get to your Series B, you should know what your unit economics are. A good growth investor won't want to invest unless you have positive unit economics. The problem with the new tech-enabled businesses, this new generation, is that their economics, their business models look much more similar to the kinds of companies they were replacing. If you look at Uber, his business model looks much more similar to the taxi cab industry. Having this model of subsidizing rides, guaranteeing the drivers a certain minimum, makes them take on the economics of the taxi cab industry. Or if you take WeWork, their economics look much more like a typical commercial landlord. They are leasing space at a markup over what they're paying. These are thin margin businesses, but if you approach them with the mindset of a pure software business, it's going to lead you to have the wrong cultural attributes, the wrong cost consciousness, and you might not even build up the finance function in a way that you need for this kind of business. The dilemma between expanding fast to beat competitors versus taking the time to dial in the model so you don't risk a unit economics problem or some other kind of blitz fail. I don't think there's a hard and fast answer. I don't think it's one extreme or the other. It depends on the situation of your market, of what the competitive dynamic is like. The fundraising criteria of late stage investors determines the balance. To the extent that there are massive $100 billion funds out there that only look at the top line, that just want to see up and to the right hypergrowth, but aren't super focused on unit economics, well, startups have to play the game that's on the field. If there's some kingmaker fund out there that's saying we're going to give $1 billion to the fastest growing company to crush their competitors, and they don't care about the economics of it, then you're forced to be that company. Recently, there's been a reevaluation, and growth investors are suddenly much more conscious of unsustainable growth, of growth that comes at the expense of unit economics. If the growth money is requiring positive unit economics, as I think it now is, it changes the game that's on the field. Founders would be wise to adjust their thinking. Just because they're the fastest growing one doesn't mean they will actually be the one to win the fundraising game anymore. If I were a founder, I would much rather have a unit economic positive model that's working in one or a few cities than to be the so-called market leader that's in 50 cities but operating with negative unit economics. I suspect that growth investors would fund that company. If you're lucky enough not to have a lot of competitors, you have more breathing room to get the model right before you expand it. On the other hand, if you have lots of competitors, you may feel a legitimate pressure to expand faster. Finding the balance between these two extremes requires entrepreneurial judgment and a board that can help weigh the risks with you. If you're a tech-enabled startup, if you're a business that has software plus a meaningful physical world component, I recommend a few things. Number one, you're going to need to develop a proficiency in cost attribution from a much earlier stage than a pure software business would. You're going to need to know your unit costs at a much more detailed level than a typical SaaS startup. The attribution can be harder than it sounds in the early days of a startup because your finance function is immature, because COGS are not typically purchased in units. They're typically purchased in larger chunks and then unitized based on assumptions. And those assumptions must constantly be checked, figuring out which costs are one-time, which are ongoing, which are temporarily inflated, which ones can be brought down with scale. These are all important factors to understand for the tech-enabled startup. Second, you're going to have to pay a lot more attention to pricing. In a typical SaaS startup, the goal is to get over the penny gap, to prove that a customer will pay anything for the product because they have perfect gross margins. But in the tech-enabled startup, you've got to make sure that you're pricing the product so that you're not selling dollar bills for 90 cents. It's easy to create the illusion of product market fit by giving away a physical world product or service for less than it costs, because the legacy competitors can't compete with negative unit economics, but you will not create a viable long-term business. The third thing I recommend that you prioritize 0 to 1 problems like establishing positive unit economics and a culture valuing operational excellence before going from 1 to N. So you've really got to think, what are my 0 to 1 problems? What are my 1 to N problems? For tech-enabled startups, you're much better off getting the operation to work at small scale in one geography, in one location, in one market, with the right teamwork, with the right culture before you expand to a lot of markets. Now, in a lot of cases, the competitive pressure of needing to go wide to beat competitors forces companies into prematurely scaling into multiple markets before they're ready. But to the extent you can hold back from doing that, I recommend that you try to get your model working in one market before expanding to a whole bunch of them. The unit economics problem has become a very big topic in recent years, precisely because startups are eating the world. You're seeing all sorts of new startups that are an interesting mix of software and hardware, or software plus a service. It could be delivery. Uber's the paradigmatic example of this type of new company where you're providing a physical world service, but it's all software enabled. Startups all of a sudden have had to get good at unit economics in a way that they never had to when they were just pure software companies. If you think about a pure software business, it has perfect gross margins, it has perfect unit economics. All of the cost is in creating the first copy of the software. It was precisely in that realization that he could make cheap mass market software and make it up in volume that made Bill Gates the richest man in the world. Software is actually quite expensive until that time. He said, let's cut the price and make it up in volume. And it worked perfectly because all the expense is in creating the first copy. The variable cost of producing additional copies is free. If you can actually sell mass market software, it becomes extremely profitable. The reality is, startups never had to be good at accounting. They never had to be particularly good at being cost conscious. Look at the Google campus, look at the Facebook campus, these Disneyland style campuses, the benefits. These are extraordinarily profitable businesses because the gross margins are so fantastic. There are no cost of goods sold. It wasn't until software started eating the world that you had these hybrid software, physical world businesses, and unit economics even became a factor. But the problem is that this took the startup ecosystem by surprise, because we were also trained to think that gross margins didn't matter, that unit economics didn't matter, because all the successful companies never paid any attention to these things. And all you have to do is look at the Google campus.
We've been talking about how to develop good judgment. We've talked about how to evaluate teams. Now it's time to talk about the product in the market. You want to apply your judgment to picking good founders, attacking large markets with credible products. The product, especially in an early stage investment, it's really just the resume for the team. It's showing you what the team is capable of. In the seed round financing, the teams have usually only been working on the product for months or even weeks. So you don't necessarily know what the end product's going to look like. It's a long ways from the finished product. But by looking at the product, you can tell their shipping cadence, which is very important. Probably the single best predictor I've found of a company's success is the cadence with which it ships. How often are they shipping new updates and new code? Because it's not the number of hours that drives learning and development. It's the number of iterations that drives learning and development. A team that iterates quickly on high quality product is much more likely to find product market fit than a team that is moving very slowly and deliberately. Obviously, this depends on the nature of the product. Consumer products, you ship early, ship often. You don't mind breaking things. Often it's tempting to fall back in hardware and enterprise software and say, well, here we have to be a lot more deliberate. But I don't think that's true anymore. The best enterprise products now are consumerized first. If you look at Slack and Notion, they're built for the end consumer, or even all the Apple products and iPhones, and then they're inevitably adopted by the enterprise. Products have to appeal at a consumer level first, which means that they need fast iteration. Even for hardware now, a lot of the smarter teams are doing 3D printing and just-in-time manufacturing, and they spend a lot of time doing betas before they go to the final product. Fast iteration is important in almost every startup business at this point. First and foremost, look at the product as the resume for what the team is both capable of and how quickly and ferociously the team iterates.
PayPal in the early days, we were losing money on every transaction. The product was free, and we were losing about 2.5% of the transaction amount because of fraud, because of credit card fees. We like to say at PayPal back then, when you're losing money on every transaction, you can't make it up in volume. We realized the solution was to introduce fees on the product. We'd been holding out. We lacked the confidence to believe that people would actually pay for this product in the early days. We always thought we were going to upsell people to some bigger, better model, to some banking model or some other financial account. We never thought people would actually pay for the core PayPal service. And what happened is we had the dot-com crash, and we simply ran out of time to come up with plan B, this thing that we were going to upsell people to. So we just said, well, listen, we got to impose fees right now on the product that we have, because otherwise we're going to run out of money. When we did that, we migrated 95% of the user base to paying for the product, and we had very little attrition, almost no one churned. Within a 6-month period, the company went from losing a ton of money to being almost cash flow positive.
When a team comes to raise money and they haven't built any product yet, that's usually a red flag. It's quite easy these days for a team to build some kind of a prototype, especially in software, sometimes even in hardware, and prove out a few things before they've raised any capital. If they haven't built any product yet, what makes you think that raising capital will allow them to build product? One of the biggest red flags is when you get a bunch of business founders or sellers who don't have any builders. And they're saying to you, if you give me money, I will go and recruit the builders. This is a technology business. Technology and product are everything. If you don't have the builder to look at, if you can't see their work, then how are you supposed to invest? It's possible to invest without the technology team, but then you're not investing in a tech company. I would rather take technology risk and execution risk than market risk and team risk. The reasons being team, it's very hard to change the core team. If you don't like the team, but you love the output, if the output goes wrong, you can't change the team. Market risk is often outside of your control. It's difficult for any individual to predict how markets are going to develop. It's in the hands of millions of people in a complex network deciding how to adopt things. So taking on market risk can be difficult, and it's better to say, wow, if this product were to exist and work as anticipated, then lots of people would want to use it and would pay for it. That is a much better place to start from. In terms of technical risk and execution risk, that is the risk that you can calibrate. That's why having the product be a resume for the team is so important, because it helps you calibrate the execution risk. I would rather take technology risk and execution risk over market risk and team risk all day long. To quote Vinod Khosla, you want to invest in $0 billion companies. If a company can't be worth at least $1 billion, you don't want to invest. If you can't make at least 100x return, you're not seed investing anymore. You're Series A investing, but you're doing it with less capital and less ownership. At the seed stage, something in your portfolio has to get to the 100x mark for your portfolio to start making sense, assuming that you have a relatively diversified portfolio. You should not invest in companies that look like they're interesting and will return 5 to 10x. Why? A lot of them are going to go to zero. Only a few will go 5 to 10x. And so it barely makes up for your losses. Secondly, you don't have enough capital at stake. A venture capitalist can put in millions of dollars per deal. So to them, a 10x return or a 5x return on a winner is very meaningful, and a 3x is meaningful. But as a seed investor, you have to go for broke. Your ownership is so small that it will not make a material difference on your life or for your investors unless the company is a massive outsized success. The venture capitalists themselves are not going to invest in things that attack small markets. VC funds are quite large. They need to generate hundreds of millions of dollars in return on a winning investment to justify the fund. So VCs will not invest in companies that are not going to be big enough. Many of the top VCs will pass on companies that are only going to get to $1 billion in market cap. Even that may be too small. Everybody's looking for the grand slams in this business, not just the home runs, as Bill Gurley likes to say. This doesn't mean you only go after things that have obviously large markets. When a market is emerging, it'll by definition look smaller. One class of emerging company that makes it difficult to invest are companies that look like they are technology companies at a surface level. When you scratch with your fingernail, there's not much technology underneath. Another way to put it is, for every dollar invested in the company, what percentage is going into technology development and what percentage is going into scaling or customer acquisition or into subsidizing rides or deliveries or some physical world product. Companies like Uber and Lyft and Postmates, DoorDash and WeWork, they can get to very high valuations, but you have to ask if it's going to be worthwhile return for you as an angel investor, given that these companies are going to need to raise tens of billions of dollars or at least billions of dollars before they can become public standalone companies. And in the process, you're going to be diluted heavily, as well as buried underneath a liquidation preference that is entitled to returning their capital, maybe even to profits before you are. It's better to invest in pure tech companies. There are always exceptions. The rise of the full stack startup was a recent in vogue thing, although recently with the market downturn, it may be retreating and we may be going back to capital efficient, tech heavy, and infrastructure light startups. A great company actually expands the market it grows in. You do have to have some sense that the market is expandable, that it is not limited to what it looks like at first glance. You can't wait for an obviously large market, but you don't want to bet on every company that's going after a small market either. You have to have some sense of this company can create a market or this market will materialize. If you have to read a Gartner report or a Forrester report on the market size to justify the market, then you're no longer a seed investor. Seed investors shouldn't be reading about market sizes in Gartner reports because those markets are mature. One good rule of thumb is if you see people trying to do something like hacking together a product before that product exists using suboptimal tools, and that gives you some evidence of customer demand and can help you estimate how large the market would be if this thing were easily available and broadly usable. Other ways to proxy the market is it helps if you're vertically specialized, you have a sense of how large the market can be. But as a rule of thumb, great startups will usually grow their own market by a factor of 10 or more compared to the current market. I credit a lot of my investing acumen with having a loose understanding of complexity science, as pioneered by everyone from Brian Arthur to Benoit Mandelbrot to Nassim Taleb. Complexity theory talks about network effects, scale advantages, complex systems, emergent properties, and so on. A lot of the great technology businesses are natural monopolies, and this is the dirty secret of Silicon Valley. The number one winner can be worth hundreds of billions of dollars or even $1 trillion. Number two might be worth a few $1 billion, and number three, you might as well have not shown up. This tends to happen for a number of reasons. For example, you should understand how, in a proper network effect, each new user adds value for all the existing users. You should understand how communities display network effects and what their stickiness levels are. You should understand scale economies and brand based scale. A lot of people think brand based scale is just as powerful as network effects, so they end up investing in companies that have a solid brand but no real stickiness or moats, as Buffett likes to call them. Then, when something with the product goes wrong or a better competitor emerges, the brand effect fails. Data based moats tend to be weaker than other kinds of moats. Interesting to understand when accumulating data is useful versus when accumulating users is useful. Real time network effects, where everyone's dialing in simultaneously to use the product, are far more powerful than asynchronous network effects, where people come in whenever they want. One of the things about the internet that causes us to consistently underestimate market size is that it hits everybody all the time. Products that seem extremely niche can quickly grow across the whole world, get into everyone's phones, and saturate entire markets before the competition even know what's going on. It's often very hard to catch up to a runaway product train because even if it's 2 months ahead, like a virus doubling every couple of weeks, that makes all the difference, especially because all the early adopters tend to get picked up by the first credible mover in the space. As an investor, what you're looking to invest in the first credible mover. This can be difficult sometimes. Sometimes you invest in the first mover, but it's not credible because the team isn't good enough, missed it slightly, or fumbles the ball. The first credible mover comes along, and now you're blocked out from investing in the competitor because your first founder doesn't want you investing in the second founder who's competitive. Then you have to watch as you miss a huge opportunity. I've seen this myself. I invested in a company at a valuation of around 5 million. A fast moving competitor came along, executed far better, and is now worth 5 billion, whereas the original $5 million company that I invested in has gone to zero. It can be a painful lesson to learn. Sometimes you invest in the right founder, wrong time. Sometimes you invest in the wrong founder at the right time. In basic economics, the important concepts are monopolies, network effects from APIs, supply and demand, cumulative advantage, moats, lock in, marginal costs, consumer surplus, producer surplus, price discrimination, pricing power, viral networking, viral adoption, economies of scale, etc. Modern microeconomics. And you can get this stuff from an economics textbook. You can get it by reading Peter Thiel's famous 0 to 1. You can get it by reading up on various mental models. You can read up complex systems and complexity theory. You can read Andrew Chen's blog. Some of the better VCs will write about it, but they'll do it in a very subtle way because they don't even want to say we're building natural monopolies. But the truth is that most of the valuable businesses are natural monopolies. Is this bad for society? It could be. We're not talking about anti-competitive or illegal behavior. But the thing to realize is that the technology industry is extremely dynamic. Even these companies that look like they have natural monopolies due to network effects transfer enormous benefit to the consumer, then tend to get defeated when the next platform comes along and there's a platform shift. MySpace gets displaced by Facebook. Facebook gets displaced a little bit by Instagram. Google displaced Microsoft from its perch position. Microsoft used to own the start button on Windows. Now, if you start on Google or on Google Chrome, or you start on Apple, look at how Apple came back to beat the Wintel empire. The technology industry is very dynamic. Just because there's a series of network effect monopolies doesn't mean that those monopolies win forever, but they can win for a decade or two, which is large enough to harvest a lot of profits. You want to avoid rent seeking and regulatory capture. Regulatory capture is something old world companies do. They work with lobbyists to get regulators to lock them in. Rent seeking is when you're parking yourself in the way and you're a toll taker and you're not innovating at all. This is a highly innovative industry. Companies that manage to capture a great position but aren't innovating will eventually get displaced. The best companies are run by founders who are extremely paranoid. One other place to learn this stuff is through Ben Thompson's newsletter, Stratechery. Ben writes about this stuff for $10 a month, and he's one of the best commentators in the tech industry and is an MBA level education reading this stuff. At the end of the day, everything is about traction. You pick a great team, go for a big market, and go for great products because you're trying to predict what is going to actually be used by the end user. What are large masses of people going to pay for or consume that they had not consumed or paid for before? Where is the attention and the money going to go? Nothing is better than traction. Traction is the ultimate evidence. That said, at the seed stage, you normally don't get the benefit of seeing traction. In a good, efficient venture market, if something is getting a lot of traction, it's also getting a lot of investment. So it's getting Series A, Series B, you're competing against the top firms. Everybody who's smart knows how to read the traction metrics. Once in a while, you will see some companies with early traction, and you have to figure out how to read that traction. At the seed stage, if a company is growing 10 to 20% a month, that's a basic solid company. Depends on the metric, but that's the rough range that you look for. If a company is growing less than 10% a month, then you have to wonder, is this going to be a blowout company? It has to somehow increase its growth rate because 10% a month is barely over 3x a year. And 3x a year, believe it or not, is too low for a seed stage company. 20% per month or greater is an explosive company. That is a company that is growing at a very steep curve, could grow 9x a year. And those kinds of outcomes tend to be very rare and very large. Generally, those kinds of growth curves are associated with very trivial products like Yo or a viral meme. It's almost like a cat picture in an application as opposed to something that's going to be sustainable. So the holy grail is to find something that is growing at 20% plus a month and has a substantial, sticky, monetizable product. In my portfolio, Uber and Notion both had explosive growth, the ability to monetize, and had stickiness. No surprise, these end up being multi-billion-dollar companies. You could look at things like House Party, for example. Explosive growth, not able to monetize, not able to survive on the Twitter graph, and ended up being a relatively small acquisition. Another example would be Turntable FM. Explosive growth, no stickiness. There's a line attributed to Mark Andreessen where he says the best product doesn't always win, but the winning product becomes the best product. It might be a Ben Horowitz line. I don't think it's always true. It's true in the sense that if you're winning, you can get the capital and the talent to retool your product to become the best product in the space. But if the space is fast growing, your team is mediocre, and it's too hard to change the product on the customers, the backwards compatibility makes you put in too many switches, dials, and settings, and makes the product hard to use, then you can get stuck in a local maxima while a fast-moving competitor who started out with a better product but was losing ends up being the winner. Whether the best product wins or not is highly specific to the situation. Especially when markets are small, you can think a certain product is winning when the market is just getting started. For example, in the iPhone photo space, Hipstamatic was the thing to beat until Instagram came along. It wasn't obvious at all that Instagram was going to win until it suddenly did. Hipstamatic had time to improve. They could have raised money to improve, but they didn't. HipChat was a premier chat product, and they were winning. They should have been able to raise infinite capital if they needed to make the product better, but Slack came along and ate their lunch, and the entire time, HipChat was unable to innovate. Parker Thompson, aka Startup L. Jackson, said that every investor who comes in after me is a spreadsheet jockey, and every investor who comes in before me is a dart-throwing monkey. At the very early stages, you are closer to a dart-throwing monkey. And at the later stages, you do drop into a lot of spreadsheet analysis. At the early stages, I wouldn't get too fixated on traction metrics. If you're fixated on spreadsheets as an early stage investor, you're likely to just annoy the good founders. Good founders are product craftsmen and craftswomen. They love what they do. They're trying to build the perfect product for their customer. If you can put yourself in the shoes of a future customer and appreciate the product, you're much more likely to recognize and win the hot deals. If you're seeing a company that has amazing traction, is willing to let you do all the spreadsheet analysis that you want, is monetizable and has a good founder, ask yourself, why am I even getting to see this deal? Why hasn't a top tier firm already picked this deal off at a valuation that's 10x what I could pay? So I wouldn't focus too much on traction metrics at the early stage. Companies are also getting very good at faking traction or exaggerating traction. If you go to an accelerator demo day, companies are trained to present the graphs in the best way possible. They'll show cumulative graphs rather than incremental ones. They'll cherry pick stats. They'll get explosive growth during the incubator session by selling to their batch mates or doing all their sales at once. And these are not sales that are necessarily sustainable. It's very hard unless you have access to their dashboards, you understand their business, and you're willing to dig very carefully to separate truth from untruth. Also, when rounds get hot and you have no time to decide, that's when you get taken advantage of in traction. Social proof only works when the actors are relatively independent and it matches up to their own internal diligence and conviction. And then social proof can be a clincher for pieces of knowledge that you didn't know, or to help you know when it's time to get off your laurels, stop waiting for an option, and close the deal. It cannot be the sole determinant of investing. It also becomes an art form, learning how to read the signals around social proof. For example, if a big VC is investing in a company, you have to look at the size of the investment. Is it a meaningful amount for that venture capitalist? You have to look at their previous ownership. Are they increasing their percentage ownership or decreasing it? Even though they might be putting in money, their ownership in this round may be going down because other people are putting in a lot more money. Perhaps the VC is only putting in the bare minimum needed to bring in more capital. The ultimate social proof is a credible investor investing an amount of money that is meaningful to them, ideally to increase their percentage ownership in a company. Generally, in subsequent rounds, if someone is already an investor, the cleanest signal they can send is invest in their pro rata. If they do less than their pro rata, especially if they have deep pockets, that implies they're losing faith in the company. If they do more than their pro rata, that implies they're being greedy in the company, and it's actually a very positive sign, although at that point, why would they even share with you? Also, you have to make sure that they don't have other conflicts of interest. When someone's a founder of a company and investing in the company at the same time, their investment signal matters a lot less. Or if they have advisory shares, or they got special deal, or it's a relative. Sometimes in venture capital, a large VC firm may be investing a meaningful portion of a round, but they're just buying an option. For example, you might see a seed company raising $1 million, the VC puts in 500K. That's not really the social proof that you think it is, because the VC may have intentions of just turning over another card. And if the company succeeds, a VC is in a pole position to get the information early and put in $50 million, which is where they really make their money. So they might be buying an option, but you are trying to buy an investment. And so you're operating on different terms. Social proof can get a bad rap, deservedly so, because it can be monkey see, monkey do, or herd mentality, where one monkey imitates the other monkey, or one person is looking at the sky, so everybody looks at the sky. There are reasons why historically humans follow social proof, because if one member of the herd suddenly yells lion and then the herd starts running, it doesn't make sense for you to stand there and look around until you see the lion. You just follow the herd, you run. If everyone in the movie theater gets up and starts running, you get up and run. You don't think twice. If there's a crowd running towards a store, you at least drift towards the store to see what's being sold. If you see people waiting in line, you can probably assume the food is decent. That's where social proof comes from. In private market investing, nobody knows everything. Each investor in the startup knows a little bit about the deal, but nobody has a complete picture. So one person might have evaluated the team well because the team used to work for him or her. Another investor may know the product well because they used to work in the space. Another investor might be good at reading traction metrics. Each one of them, by investing, brings that additional information to the table. But the price doesn't move. You can't follow Warren Buffett into a hot deal because Warren will only tell you a month after he's done the investment. And the instant after he did the investment, the price of the deal went up. And certainly by the time he announces it, the price goes up even more almost immediately. However, in private markets, the price of the round stays relatively fixed until the entire round is done. So it's advantageous to be a late credible mover. There's a psychology trick when you're trying to find out the reason why someone is doing something or not doing something. If you're trying to make a sale and someone politely declines, they'll give you a reason. The first reason is almost never the correct one. If you can get a second or a third reason out of them, you're much more likely to get to the correct ones. The trick is to ask in a way where you bypass their filters. So you say, well, I understand you're passing because you don't have the budget this quarter. But I'm curious, if you had the budget, is there any other reason you'd be passing? And they'll say, well, it's because our CFO didn't love the UX on the product or didn't feel like it integrated with our core system. So you're more likely to get the honest answer in the second or the third reason why. Because eventually people run out of excuses and they still feel the need to fill the silence, especially when you've asked a piercing question in a polite way. So with a startup, when they show you certain metrics, you can dig a little and say, well, are there any other metrics that I should be looking at? Are there metrics that you're concerned about? If there are metrics that were to go down in the next few months, which ones would they be? Or which metric do you wish you could improve more than the core metric? Good investors show their best deals to their friends. So, one subtle signal of social proof is when you see a group of investors that like to invest together investing. That means they've socialized the deal already with each other and it has been a hit. There's also the Peter Thiel rule, which is when a company's valuation is climbing very rapidly in between rounds, rather than scaring you off, that should attract you because humans are bad at calculating nonlinearities as long as that round is led by a credible or top tier investor. So when you see a company go in 9 months to 5 times the valuation that it had before, you might automatically think it's overpriced, but that's because your brain can't handle the fact that a company might actually grow 10x in 9 months. If an investor is telling you to invest in a company but not investing themselves, then obviously that's a highly negative signal. Investors should not introduce companies they are not investing into other investors, even though sometimes naive founders ask them for introductions, 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 ask them for introductions.